The betting markets have gotten way ahead of themselves. This is still a toss-up.
There's a lot of concern that a Trump administration would mean more inflation.
Trying to understand what's a press release, what's a meme, and what is actually implementable remains a big question.
Both parties have platforms to stimulate the economy.
Many of the big issues facing this country are going to be facing us no matter who takes charge.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with equity futures on the S&P 500 pulling back here across the board. We're still poised just about for a sixth month of gains on the S&P 500, the longest monthly winning streak going back to 2021. Look out below on the Nasdaq 100. We're down by more than 1 full percentage point. Two names to watch in the pre-market. One is Microsoft. The other is Meta. Just a little bit lighter on cloud revenue over at Microsoft. Lisa, that name down 4%.
Yeah, the expectation also coming in just a touch. A key question for me, is this capacity or is this demand? What we heard from the CFO was that this really has to do with just limited capacity to fulfill on some of the AI bets. That's a short-term issue if they can get those chips. The question is, are we seeing Google take on a greater share of the business as they seem to have more capacity?
It's so interesting that these stocks are down this morning because actually the quarter was good. Microsoft revenue was up. Cloud computing, revenue up. The signal that it's going to be slowing down. Also, how much more both these companies are going to have to spend, that capital expenditure on AI. But it's the reason, because of AI, that this entire year, those stocks were flying high.
Well, let's talk about the CapEx spend. This is over at Microsoft. Quarterly CapEx, almost $15 billion. A record, up 50% from the same period last year, and they're going to keep on spending into 25.
So we talked about how are we seeing investors push back against increased spending? Is this going to be a problem? But I'd flip the script just a touch and say if you can show the money from it, they're going to be okay with it. It's not a big deal. Question is, are you showing the money with it? Microsoft, Facebook, Meta, not so much. And that, I think, is the big issue. Is there a fear that Mark Zuckerberg is going to go back to the Mark Zuckerberg of yore before the efficiency moment and really go back to spending even while burning cash at a pretty fast clip in certain businesses?
Meta is down by a little more than 3%. Let's talk about the bond market as well. 2-year, 10-year, 30-year. Yields are coming in just a little bit. We're down a basis point on 10s, likewise on 2s. On the month, though, the 2-year and 10-year yield up by around 50 basis points apiece. The conversation that has dominated everything we've talked about around this table now for the last 4 weeks. Is it the economic data or the politics? And if it's the politics, there seems to be, I would say, some divergence between the conversation on Wall Street, which is Trump trade, and what you're hearing from the pollsters, which is this race is still really, really tight.
And then people will say, well, then it's the economy, and that's what's really affecting yields, which you do see right now. Yesterday, I've been looking at the Trump media and technology stock, and that's sort of the best and sort of cleanest view. And yesterday it tanked 22%, although it's up something like 300% so far this year. There's a key question, how much one poll or another could shift betting odds that seem to have a very clear answer. Honestly, I'm not getting a clear answer from anybody on how much you can really dissect the different features into the bond market.
CNN yesterday had a brand new blue wall where Michigan, Harris is up, Wisconsin, Harris is up, but all of this is in the margin error. Pennsylvania is where they're tied. Fox News comes out with their battleground poll. Pennsylvania is where they're tied. And if you look at some of the research that's done by Oxford Economics, where inflation hurts the most is in a place like Pennsylvania. This stood out for me. Every 1 percentage point increase in inflation before a presidential election is linked to tens of thousands of Pennsylvanians voting against the incumbent and for the challenger. This state is so important, and right now it's on a knife's edge.
There's a huge week coming up for financial markets worldwide. Tomorrow morning, payrolls. Next week on Tuesday, the election in America. Then 2 days later, a week today, a Federal Reserve decision at the FOMC looking to reduce interest rates by 25 basis points. Coming up this hour, we'll catch up with Lori Calvasina of RBC on a disappointing earnings season. We'll speak to Heidi Crebo-Rediker of the Council on Foreign Relations on the fallout from Biden's garbage comment, and Stefan Slowinski of BNP Paribas Exane as Amazon and Apple prepare to report results. We begin this hour with disappointing tech earnings weighing on stocks, Meta warning of more AI losses, and Microsoft predicting slower cloud business growth. Lori Calvasina of RBC with this to say. The early S&P 500 stats are now pointing to a mildly disappointing third quarter reporting season so far. General discussions of the outlook, macro backdrop and business conditions remain mixed, as has been the case throughout 2024. Lori joins us now for more. Lori, good morning. morning.
Thanks for having me.
What a week we've got coming up. Let's start with these earnings. What do you make of what we've heard from tech so far?
Look, at the beginning of the week, right, I felt like maybe it could be a little bit better than what we heard last week. And I just came out of last week saying, and I actually felt really good on week one post the financials. And then, I kind of felt like I got beaten down. And we're broadening out this week. But I think the issue is, right, coming into this week, there's been a lot of nervousness on this AI story, right? And if I think back to last week, I wasn't getting a whole lot of AI commentary in the transcripts I was reading through. So it felt like maybe this is the first big week that we're going to get, some real meaningful insight. And investors obviously aren't liking what they're hearing out of the gate.
If I'm company X and I turn around and say I'm constrained by capacity, is that a good problem to have?
I don't know, to be honest. I think the issue with this AI trade, right, is that it's just very, very messy. And investors are worried about overbuild. So they're kind of like looking at the long term and the short term. And the short term, it doesn't sound like is satisfying anybody right now. And the longer term, I think, is a little bit unclear. And if I think back to sort of all the customers of these big cap tech companies, right, kind of the end users of AI, that's where things are getting very messy. And I've characterized this in my meetings. If you look at some of the end use cases, and we're starting to get more of those these last couple reporting season. Some of them, I read like business services companies, really data-intensive companies, and I say, okay, they're doing some stuff here. Other companies, I'm hearing about catalogs. All in all, it's feeling a little small potatoes to me, and I think that may be part of the problem.
So one of the reasons why I love speaking with you is because you do analyze all the transcripts from earnings calls to get that kind of guidance.
Yeah.
How much was AI mentioned versus previous earnings cycles so far?
So I don't have good stats yet on October. We like to run the stats on a quarterly basis. It does get very lumpy month to month, but we actually use the Bloomberg, transcript tool to measure this. And coming into this, when we crunched the numbers through September, if you looked at it on a quarterly basis, we were still at extremely elevated levels on AI discussion. It actually looked kind of like the chart we ran on the Fed and interest rates, where it had just gapped up and sort of plateaued. And so we weren't seeing any kind of like big drop off, any big surge, but it was just sort of maintaining steady at very high levels.
The reason why I ask is because I think what you mentioned is really important here, which is companies are in the same place that investors are in.
Yeah.
Show me the money, show the efficacy, and how much does it really how effective these AI tools are that's going to determine the fate of the stock. And I'm thinking with an eye toward Apple, which is going to report after the bell today.
And let me give you just some additional context. So if you look at S&P 500 bottom-up consensus forecasts, they've actually come down a little bit in recent weeks, but normally they don't do much in the second half of the calendar year. They basically, we've done this study, you go to the summer of the prior year, they get worked down in the first half of the year in question, and by the time you get to like June, July, they're set. And we haven't had that in this cycle. They've been pretty similar to where they were last summer. There's a lot of stability, and so now we're starting to see them nudge down a little bit, and it feels like maybe we're getting some pent-up downward revisions that we should have already had. And that's not speaking to any one specific company, right? But these big mega cap tech, AI secular growth names are big contributors to that, right? So I just feel like maybe we're just catching up to something we should have done already.
Lori, how much of the commentary is focused on the U.S. election, and are people still staring into the sun?
I actually feel like I need to be looking for my eclipse glasses right now. We need something a little bit stronger than sunglasses, but we ran a similar analysis just looking at the quantitative trend, and we saw a spike in the last couple quarters on election commentary. We certainly felt that in our transcripts. I will give you a little bit of comfort in that it was on par with what we saw in late 2016 and late 2020, so it's no more than usual. But the element of uncertainty is enormous, and that's what we keep seeing companies talk about both this and last reporting season, that the uncertainty is just huge. It's weighing on business activity. We're even seeing some consumer companies starting to talk about that.
A few months ago, you put in your note that you actually see some credence in the fact that there is a Trump trade developing. Do you still see that?
So we saw that back in the fall, and then kind of disappeared, and now we're starting to see it again. And so I've been getting a lot of questions the last week or two, like how much Trump is in the market, right? How much of it's baked in. People are trying to put percentages on this, and I don't think you can do that. If I think about my clients, so I'll give you qualitative and quantitative. The qualitative is that when I talk to long-only investors, they are confused about what is going to happen on Tuesday. They are confused about what to do once they do know who the winner is. And they are talking, but they are not doing much. They are trading on earnings, but they're not really trading on the election. Now, that's long-onlys, mutual funds, portfolio managers, hedge funds. I'm not quite as sure. I am starting to see questions come in where people are trying to gauge, in the different scenarios, what's the S&P 500 going to do? So it is starting. If I think about it quantitatively, small caps, the dollar, 10-year yields, we are all starting to see very close correlations between either polling data or betting data, specifically looking at Trump, and those assets. And I can't sit here and tell you that's the only thing driving those, but I am seeing enough in the data to know that somebody somewhere is moving something. I don't think it's everybody. I don't think it's widespread. I think it's kind of a thin market and it's getting pushed around.
So we've got to consider the balance of risk into next week. Do you think we're vulnerable to an unwind? As you look at some of these trades, you mentioned a few of them, this whole long dollar, short bonds, long US equities versus the rest of the world. Do you think we're vulnerable to an unwind? Or are there enough tailwinds beyond politics to support those trades?
I think it depends on your time horizon, and I think it depends on the specific setup that we have. I mean, Lisa was talking about betting markets earlier. Those betting markets are not all uniform. So I'm going to brag about you guys. You have this fantastic page, WSL Election Go. You can track all the different betting markets, and you're not seeing the same thing in predicted and poly market right now. So you're actually starting to see the data shift back towards Harris in the predicted data. You're not seeing that in poly market. So I don't know what is going to happen over the next 5 days. I do know that traders are queuing off those betting markets, regardless of whether or not you think they're useful outcome predictors. I do think, though, if we sort of keep where we are and we end up having a Harris win, I do think you're going to see some of this stuff unwind. Now, longer term, what does that mean? We did a survey of our analysts in late September, so we're not baking every single policy crumb in there because a few more things have come out. But we asked our analysts, gauge the outlook to your industry under these 4 different outlook scenarios. So the 2 sweeps and the winners with a split. And it was interesting because when I averaged all their scores together, they were basically hovering around neutral. There were tilts, so Trump had a little bit of a bullish bias. I think it was like 0.38. Very bullish on my scaling would have been +2. Bullish would have been +1. 0 was neutral or mixed. The Harris win with a split Congress was -0.04. Right smack dab on neutral. So, when I talk to investors, they struggle with things on the Trump side. And again, this is the long-only crowd. Corporate tax cuts are good. Individual extending those tax cuts are good. Tariffs are bad. And I think the conflicting cross currents really is at the heart of what has the longer-term investors confused right now.
There's an idea that's gotten a lot of popularity, which is that the bond market is being moved around much more than the stock market. Do you agree with that that's really going to be the node of volatility post-election? Well,
I'll tell you, I'm an equity person, not a fixed income person. And I always joke I don't speak bond market well. But the reality is that, I've got like 4 charts in my deck, right, that are looking at these correlations right now. And we really just focused on the time period after Harris came in. The cleanest, tightest correlation that's been going on for the longest period of time is the one between Trump and the 10-year yield.
Laurie, appreciate your time. We're watching the same things, looking ahead to next week with dread. For many reasons. Laurie Calvasina of RBC. One of the big reasons is this could be a very, very long week next week, and it might spill into the following week as well. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Just wanted to give you some specifics on those big tech earnings. Microsoft falling nearly 4% in the pre-market trade. Earnings and revenue beat estimates, but it did forecast slower quarterly cloud revenue growth. Microsoft is struggling to bring data centers online fast enough to keep up with demand for AI services. CEO Satya Nadella reiterated that he is committed to expanding AI opportunities and winning new customers. Meta shares, those also lower pre-market, 4%, despite a narrow earnings beat. Chief Executive Mark Zuckerberg said that it will ramp up heavy investments in AI and other futuristic technologies, which he says are core to the company's future. Meta cautioned that its losses from the AI division, Reality Labs, that will continue to widen this year. Reality Labs reported a $4.4 billion operating loss in the quarter. The LA Dodgers are world champions once again. After falling behind 5-0 in Game 5, a series of defensive mistakes by the Yankees opened the door for an LA comeback. The Dodgers plated the winning runs in the 8th innings and sealed the championship with a game-ending strikeout. It's LA's 8th World Series ring and the first for superstar Shohei Ohtani in his first season with the team. Freddie Freeman was named Series MVP after a record-breaking performance at the plate. And that's your brief, John.
Danny, world champions. Is that what we say?
It's Canada, too. It's the world.
World champions. Is that what we really say about this?
I guess the Dodgers won. Look, I went to bed and the Yankees were winning 5-0. I slept so well, and then I woke up to this terrible news. What happened?
America and a little piece of Canada. The World
and a lot
Series.
Of viewers in Japan.
Very true. Truly global. Up next on the program, reclaiming the garbage narrative.
Joe Biden's comments were the direct result of Kamala's decision to portray everyone who isn't voting for her, which is a lot of people, as evil and subhuman.
That conversation up next. Live from New York City this morning. Good morning. The longest week of the year begins tomorrow. Payrolls just around the corner. Then it's on to the election in America, and after that, a Federal Reserve decision. And hopefully we have a result from that election, and this market can trade with some clarity on the outlook for 2025. Equity futures on the S&P down by 0.8% as tech earnings come in a little bit softer. Bond yields are lower by 2 basis points. The 10-year 427.63. Later this morning, some jobless claims data. Under surveillance this morning, reclaiming the garbage narrative.
Joe Biden's comments were the direct result of Kamala's decision to portray everyone who isn't voting for her, which is a lot of people, as evil and subhuman. They treat our whole country like garbage.
Here's the latest this morning. Donald Trump leaning into President Biden's garbage remarks. Meanwhile, Kamala Harris distancing herself from the president's comments.
Let me be clear. I strongly disagree with any criticism of people based on who they vote for.
Heidi, Crebo-Rediker of the Council on Foreign Relations writing, final days come down to turnout. Does the floating island of garbage insult remind Puerto Rican voters in swing states of Trump's poor treatment of the island after Hurricane Maria? Seeing massive backlash, but will they vote on it? This could make or break the election. Heidi joins us now for more. Heidi, just elaborate on that. Your thoughts on the last few days, this word garbage, and how it may shake up this election race.
So I'm paying a lot less attention to the Trump comments on garbage than what happened at Madison Square Garden on the floating island of garbage comments. And I think the reason that I'm thinking that is because right now it really does come down to turnout. The polls are razor thin in the states that matter, in the communities that matter. And so if you're undecided and you haven't voted yet, what's going to make you decide? If you're ambivalent and you are, you need an actual reason to vote, is what Trump's talking about going to actually, turn the dial for you? Because I think his supporters are pretty, they're pretty committed, and if they haven't voted already, they're probably going to vote for him regardless of the garbage comment. For the Puerto Rican community, I think it's really a wild card. That's what I'm paying attention to, because that comment at the event at Madison Square Garden, even though Trump did not make it himself, he never apologized for it. And it insulted and reminded Puerto Rican voters in swing states of Trump's poor treatment of the island after Hurricane Maria, about the way he delayed aid. And then when he got there 2 weeks after a devastating hurricane, he threw a bunch of paper towels at the crowd. And so, it's a question of whether or not these very large Puerto Rican, specifically, populations in these swing states. Anne Marie was talking about in Pennsylvania. 500,000 Puerto Ricans live in Pennsylvania, in a state that Joe Biden, when he won last time, it was on 80,000 votes. So, we're talking about very large numbers who could decide they're really not very happy about what they saw more than 4 years ago in the treatment of Puerto Ricans. It was insulting, and it could move the dial.
Heidi, of course, the flip side of this is a large part of individuals can also be turned off on the President of the United States comments that half of Trump supporters are, quote, garbage. And Kamala Harris is now having to clean up Joe Biden's comments. Is he doing more damage to her every time he goes out and speaks?
So I think that it was unfortunate that he used that language, and it obviously harkened back to comments that were made during the campaign with Trump and with Hillary Clinton. So but again, if you are going to, it's really about a narrow swath of voters and what can motivate them to change their decision. Or if they are turned off of politics and just want to sit this election out, what can make them actually get up out of their house and actually cast that vote? And I don't know if President Biden's comments, which we're not reelecting President Biden, if they actually are going to move the dial for that very important group of undecided or ambivalent voters.
Heidi, how do you think she sticks the landing when it comes to the economy? The FT this morning calls Kamala Harris's other electoral foe inflation. This continuously shows up in polls. How does she distance herself in these final days, in these swing states, from the current administration when it comes to inflation?
So it's a hard narrative. I mean, people are generally hurting from the fact that that goods, the everyday goods cost more than they did pre-COVID. I guess what I would suggest is that it's not just looking back over the last 4 years. It's looking forward to what a blanket tariff policy across all, the whole world of 10 to 20% and 60% on China, what that actually could mean for inflation. Well, it's probably those kind of tariffs are inflationary. Tariffs we've had for many years. We know what they do. They're inflationary, and it depends if they are tactical and targeted versus across the board. I don't think that voters really understand that Trump saying that he is tariff man can get into the Oval Office day one and actually, without any checks and balance, he can actually implement his across the board tariff policy that would be inflationary. And what does that mean? It means that it's going to impact consumers, intermediate inputs, like for every business that's part of a supply chain. You can count on retaliation. You'll blow up all of our FTAs with countries, and our allies will push back pretty heartily against us in a world where we actually need our allies. We don't need to alienate our allies. So I think that there are, it's not only inflation, but you could have both, commercial inflation and geopolitical reactions that would be highly negative. What does the Fed do? We're talking about the Fed for next week. What does the Fed do if they're facing, challenges to inflation on one side, and then spillovers that might impact credit markets, mortgages, company borrowing? You're going to be in a very different dynamic if we come January and you have massive across the board tariffs imposed.
Heidi, what are you watching in the final days of the election race?
So, again, the markets are not a good predictor of who's going to be in this election, who's going to win this election. But I do think that the fact that you've had a lot of women show up in early voting, you've had, and the gender divide plays very much into Harris's camp. The fact that you do have these narrow populations who can actually really determine the election one way or the other, and we just don't know. Anyone who tells you they know who's going to win doesn't know what they're talking about. We are neck and neck right now, and we're not going to know until the votes are finally counted, and that might not be next Tuesday, might not be next week.
Don't say that, Heidi. I'm hoping it's all over by then. Heidi, appreciate your time, as always. Heidi Crebo-Rediker there of the Council on Foreign Relations. Just on tariffs, we'll catch up with Seth Carpenter at Morgan Stanley a little bit later this morning. Seth believes that those tariffs, implemented as proposed on the campaign trail, would lead to slightly higher inflation, slightly lower growth, so some stagflationary wins there for this market to deal with, potentially. And of course, potentially is doing a lot of heavy lifting whenever we talk about this stuff. Equity futures right now on the S&P 500, negative by 0.8%. Tech weighing on this market this morning. We'll hear from Stefan Slowinski of BNP Paribas Axan following disappointing results from both Meta and Microsoft. That conversation up next. Equity futures down 0.8%. Check out the Nasdaq 100 down by 1 full percentage point. Tech weighing on this market this morning. We'll have more on those earnings in just a moment. But let's just take stock of the month so far. The S&P 500 heading towards 6 months of gains, the longest winning streak going back to 2021. Utilities have been a major winner of the year so far. They've had a difficult month, and here's the why. Get to the bond market board. 2-year, 10-year, 30-year. A move of almost 50 basis points in and around on both a 2-year and a 10-year on the month so far. 416 on 2s. On 10s, we're down 3 basis points on the session, 427. That's been the big surprise of October.
And it's come with both the political potential overlay as well as the economic data. The Citi U.S. Economic Surprise Index now at the highest level, continuing to climb. It's the highest going back to April. Yesterday, that jobs report from ADP. Normally, we dismiss ADP unless it's particularly remarkable, and then everybody points to it, really highlighting quite a bit of strength just confirmed by the GDP report today. What happens if we get core PCE that also comes in hotter than expected, the key metric the Federal Reserve looks at for inflation?
ADP's not flying solo. It's reinforced by the Conference Board, consumer confidence as well, by jobless claims over the last weeks too. Jobless claims again in about 2 hours' time, so look out for that. Big question in the bond market in America, do deficits matter? In the UK, apparently they do. Look at this move. 2-year, 10-year, 30-year. Over in the United Kingdom, the 2-year higher by, let's call it 8 basis points, the 10-year up by 5. This is what the debt management officer's got to say. It's going to sell 297 billion sterling of government bonds this fiscal year. That's the second biggest target on record, widely expected. This is what we're thinking about coming off the back of the budget. Investors all pointing to the official projections that imply around an extra 142 billion sterling of borrowing over the next 5 years. Does debt and supply matter in the UK this morning? Apparently it does.
We saw yields go up. We saw a real response, but it wasn't a Liz Truss moment. And I guess that's sort of the goal of the whole affair. Deutsche Bank put this really well, saying this marks one of the largest fiscal loosening of any UK fiscal event in decades. And it raises this question that you raised yesterday, John, which is essentially you had this divergence between the U.S. and UK. And is the UK going to move a little bit more to the U.S. than the U.S. in terms of fiscal restraint moving toward Europe?
There's a word I would use, and it's yet, not yet a Liz Truss moment. Let's see how this market deals with this. Let's see if it deals with this in a sensible fashion. Bear in mind that the Liz Truss moment, there were other things going on in financial markets at the time that contributed to that move. I'd pinpoint this one, November 7th. We've got a Federal Reserve decision, also got a B of E decision as well. How is the Bank of England going to think about these numbers? Because the move at the front end really is a market that's assuming this Bank of England is going to back away from rate cuts. And we'll find out next week if that is truly the case.
And that was part of what was underpinning some of the moves earlier when you did have a bit of an overreaction. You also have to see what the growth projections are. And as people look through the line items to understand how much growth really does offset some of the increases in spending.
Sterling, 129.95. Under surveillance this morning, Meta and Microsoft delivering some disappointing results. Meta warning of more losses as it continues to ramp up spending on AI. Microsoft forecasting just slower cloud revenue growth, just a little bit softer. The stock is down by close to 4% on both Microsoft and Meta. Though on the year so far, these stocks have been absolutely flying.
Yeah, I looked year to date. Meta is up 70%. I mean, Meta has just been absolutely flying. Microsoft has seen its lead chipped away, and suddenly year to date it's up some 15%, still doing really well. But you just see this feeling, are we really kind of reaching a tipping point where companies are reassessing how much they need to invest in this? I also wonder how much Microsoft is sort of hamstrung between the expense of NVIDIA chips and the ability to really innovate and roll it out and compete at a time where you see companies saying, OK, hold on, let's see how good some of these apps really are.
Being constrained by capacity is not necessarily a bad thing. Some people might consider it to be a good thing. It becomes a bad thing when investors are losing patience over how much you're spending on CapEx already. And I wonder if that's the moment we're in. Just how much patience is left going into 2025?
Yeah, especially at a time where the data and the technology is changing so quickly that people might say, well, if I wait another extra couple months, then maybe I could get something even better. Honestly, what you did see was also a very high bar set by Google. And frankly, Microsoft just failed to meet that very high bar, and it was penalized pretty significantly.
When it comes to AI, it's not even just the expense on chips, and maybe NVIDIA is holding the back, or the expense on the actual products. It's also the expense on the actual energy to run all of this, which we've seen a number of these companies go out and ink their own energy deals. This line stood out for me from Microsoft CEO Satya Nadella. company's AI business is on pace to clear a $10 billion annual run rate of revenue next quarter. That's pretty incredible.
Amazing. That stock is down just slightly. We'll pick up on that story in just a moment. The latest out of Japan, the Bank of Japan keeping interest rates unchanged, but allowing for the possibility of another rate hike in the coming months. The yen gaining strength after Governor Ueda said currency markets have had a major impact on the economy. Dollar yen's down about 0.7% at 152. It was heading towards the worst month going back to November 2016. Just erasing some of those losses, but still on the month, we've had a 6% move on dollar yen this month. And for anyone familiar with foreign exchange markets, 6% moves on major currency pairs are monster moves.
The yen has been in a world of its own for the past couple of months. And now the question is, how much is the Bank of Japan realizing they need to explicitly say they are targeting the yen to try to prevent it from weakening too much? Economists surveyed by Bloomberg expect that if the yen hits 155 against the dollar, the prime minister will probably say, you know what, go ahead, hike those rates.
Just a little bit of yen strength off the back of that story this morning. Let's stay in Asia and move to China. China's economy showing signs of stabilizing following stimulus measures. The National Bureau of Statistics saying factory activity unexpectedly expanded in October after 5 months of contraction. PMI data also coming in higher than expected. So things just improving slightly, but still waiting for the boom. I think in the West we're still waiting for the boom that doesn't seem to be evolving over in China just yet.
Two things. The fact that they came out with stimulus before the election makes me realize maybe things were even worse than some people had been expecting. And you're seeing that just on a peripheral level with some of the earnings that have been coming out. And number two, just the fact that they're holding their MPC meeting from November 4th to November 8th to figure out how big the bazooka is going to be after, guess what, the election's already supposedly rolled out, and maybe we'll know who won. So it raises the question, how much more will they have to go and stimulate if one person gets elected over another who might go harder on tariffs?
That's the latest out of China, looking ahead to 2025 and what might be in store for those policymakers. If you are just joining us, welcome to the programme. Equity futures on the S&P down by about 0.8%. Disappointment over at Meta and Microsoft weighing on stocks this morning. Looking ahead to Apple and Amazon, both on deck, as those companies report after the closing bell a little bit later on today. Stefan Slowinski of BNP Paribas with tempered expectations for Amazon, writing, after being a market favourite in 23 and early 24, sentiment has cooled a bit with concerns over margin progress. We see the outlook as balanced. We're neutral rated. Stefan joins us now for more. Stefan, welcome to the programme. Let's get to later on this afternoon after the close. What's the first thing you'll look for?
Yeah, so today on Amazon post-close, I think three things people are going to be looking at. Of course, Amazon Web Services growth, no surprise there. 21% is the buy-side expectation, we believe. With those good Google Cloud results and actually Azure results being pretty good, maybe investors will be looking for even more upside there. Is Amazon finally catching up in AI relative to Google with the Gemini model and, of course, Microsoft with that GPT model access? Second thing, as we point out, is those North American margins. That was such a big driver of the story last year, improvement in profitability. It's kind of stalled this year. You've had things like Project Kuiper, satellite launches pop up and hold back margins a bit. So consensus is expecting a big step up in Q4. Will we get that? And the third thing is just overall top line. What is the consumer like? We saw eBay disappoint last night. There's been mention of maybe consumers holding back because of the election. Last quarter, third-party sellers at Amazon seem to be holding back. So we could see revenue growth guidance fall into the single digits. And with a stock on 30 times plus earnings, is high single-digit growth enough?
Stefan, the politics, I think, tees up a fourth thing to look at, and maybe it's a 4Q story. Do you think there could be a Bezos boycott emerging for some Democratic voters?
I don't know about that, but we are starting to field questions around Amazon and potential impact on from tariffs. So, what would that mean for the price of their goods? And also, what would it mean for the pocketbooks of those shoppers shopping on Amazon? So as we head into next week, amongst the larger cap tech, the larger cap software coverage, that's probably the one that people are starting to get a little bit concerned about from a tariff standpoint.
So tariffs more important than, say, regulatory action, Stefan, is that correct? And I ask this because we've heard a lot in a number of different reports about what the specter of potential breakups or restrictions could be with respect to either candidate, depending on who they put in their cabinet positions.
Yeah, I think in this space, obviously Google's the one that's under the most imminent regulatory threat. So that's an overhang that we've seen on Google stock this year. I think when you look broadly, there are always questions around Amazon, Meta, Microsoft, in the U.S. and internationally about regulation. But we'll see if that changes under new administration. M&A is also a big topic. I think these companies have all been a bit gun shy after Amazon got blocked for buying iRobot. And so maybe they're holding back on that, and we'll see if they open up the M&A guns post-election.
So that's Amazon. With respect to Apple, there's some really interesting questions about how high the bar is for them to show outperformance at a time where there still is lingering skepticism about their ability to really implement AI with any kind of speed and efficiency and, frankly, use cases that will encourage some sort of upgrade cycle. Stefan, how high is the bar at a time where Apple is maybe the most exposed to a number of different issues that are out there?
Yeah, I think Gen AI data is important for all of these companies. What kind of usage are we seeing? Obviously, Apple Intelligence launched just this week, so probably a bit early to get that data. Last night, we heard Meta talk about 500 million monthly active users already for Meta AI. Of course, Google talking about rolling out their AI capabilities across 15 different apps with 500 million users. So, certainly that's something that's in focus. Obviously, AI monetization. I think Microsoft was reminding you last night, we are the monetization kings when it comes to AI and software with that $10 billion ARR that they expect this upcoming quarter. And then, of course, cost. Apple's not the one that's spending the most on CapEx. Will that change? Will they invest more in their large language models? For now, it's really still Meta, Google, Microsoft that are leading on that CapEx front. And that's where people are getting a little bit nervous. When are we going to see light at the end of the tunnel in terms of CapEx growth slowing and revenue growth potentially accelerating?
Stefan, we're a week away from the U.S. election. John was leaning towards this when he talked about this boycott potentially of Prime, because we have seen a boycott in Jeff Bezos' Washington Post, people canceling their subscriptions. But the course of the past 2 weeks, we've learned about Tim Cook having a check-in call with the former President Donald Trump, Amazon CEO doing the same, the Google CEO calling him up. Are you seeing a tactical shift in the tech space and these CEOs hedging their bets for a Trump administration?
I mean, I think when you highlight the data points, about those CEOs obviously remaining neutral and, courting both sides of the campaign, that's something that they're continuing to do. So, like I said, we don't know what the outcome will be, of course. And, these companies are hedging their bets. Regulation is an area of focus. M&A is an area of focus. And so, all these companies essentially are trying to, stay neutral as we head into next week.
Good luck to them. Stefan, good to catch up, sir. Thank you. Stefan Slowinski there of BNP Paribas Exane. I think we all saw the reports in the last few days that the Post has lost, 250,000 subscribers?
At least, almost immediately, 250,000 subscribers. And to your point, The Atlantic came out in an opinion piece and said, don't cancel the Washington Post, cancel Amazon Prime. This is going to be a potential problem for a lot of CEOs. They want to stay out of the spotlight of politics because they don't want the blowback on their companies.
We'll see if this comes up a little bit later. NASDAQ futures right now down by 1 full percentage point. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Stellantis reported third quarter revenue that slumped 27%. It shipped fewer cars from factories in most of its major markets. Here, as you can see, there are still higher pre-market, nearly 3%. Analysts say that European revenue helped offset North American weakness. Stellantis has seen, though, delays in new models, product recalls, and shrinking market share in both the U.S. and Europe. Starbucks reported its third consecutive decline in same-store sales. Shares little change this morning, up just 0.5%. The new CEO, Brian Nichols, said that he's focused on the future, aiming to reduce drink customization, trim the food and beverage menu, and bring back touches like ceramic mugs and a condiment bar to make sure that the Starbucks experience feels less like fast food. Nichols also said that a goal of getting drinks in-store to customers in less than 4 minutes. President Joe Biden and First Lady Jill Biden hosted their final White House Halloween event on Wednesday. Yes, that is for the First Lady dressed up as a giant panda to greet trick-or-treaters. Her costume was a reference to her participation in the Washington National Zoo's announcement earlier this year that pandas would be returning to the nation's capital. The animals arrived 2 weeks ago. The White House said her costume was a, quote, welcoming gesture. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, the economy front and centre on the campaign trail.
I will give a middle-class tax cut to 100 million Americans.
You know, I had no inflation, and we had the best economy in history.
That conversation up next, live from New York. You're watching Bloomberg TV. Tough morning so far, down 0.8% on the S&P 500. Losses on Meta, on Microsoft, going into numbers from Amazon and Apple after the closing bell. In the bond market, yields a little bit lower. We're down 2 basis points. The 10-year 427.63. Under surveillance this morning, the economy front and centre on the campaign trail.
I will give a middle-class tax cut to 100 million Americans. Enact the first ever federal ban on price gouging on groceries and fight to make sure that hardworking Americans can actually afford a place to live.
You know, I had no inflation, and we had the best economy in history. That's a nice combination. But she did nothing about it.
So here's the latest. Harris and Trump honing in on the top voter issue, the American economy, as polls still show a finely balanced race with less than a week until Election Day. Kurt Reiman of UBS saying the next US president should inherit an economy with firming activity and declining inflation. Although price levels remain uncomfortably high for many Americans, higher tariffs and the expiration of tax cuts are key risks to the outlook. Kurt joins us now for more. Kurt, welcome to the programme.
Thank you very much.
Before we get to the outlook, let's deal with the here and now. Just this difference between the way we talk about the economy around this table, from a financial market perspective, GDP's great, unemployment's low, this economy is still resilient, it's doing well. The word solid comes up repeatedly in research. How big a difference is there between that conversation and what you see in polls?
It's the number one issue that Americans say that they think about when they go to the polls. It's extremely important. And there is a disconnect between what we talk about, where we say the economy is decent, and what we're talking about is that a year ago, the worry was a recession. So today, it's not a recession. If you look at some indicators like inflation that came down, people are feeling less miserable. They're not feeling better or euphoric. This is an economy where people are going to re-up their car insurance or their home insurance, and they're reminded of the high inflation rates over and over and over again. So this is not an issue that's going away for them. If you're looking at what the Fed is thinking, they're saying, yeah, the economy is balanced, inflation's come back to target, growth is looking better than we thought it would look 6 months ago. The consumer is in decent shape, but if you ask Americans how they're feeling, it's a very different reaction.
When you look at the swing states, is there one state that stands out where inflation maybe is hurting Americans more?
Not particularly, no. I wouldn't say that you could pick that out from the states, but what you do find is that there's a very big difference between what voters in the swing states feel are important issues coming into the election. A Gallup poll from September ranked what Republicans thought were the 5 most extremely important issues going into the election, what Democrats thought were the 5 most important issues. There was no overlap whatsoever. Republicans, by a much larger majority, find that the economy is the top issue. Democrats, it's not even in their top 5.
When it comes to the economy, though, and you look at what economists say a Trump administration could bring, it could bring higher inflation, which is exactly what they say they're going in to solve. Is that landing?
Not to my, what I would say is that when you think about the outcome of the election and what is likely to turn into policy, we first have the presidential election, which is a toss-up. But then when you go to what's going to be enacted, what is going to happen with legislation, whatever majorities we have in Congress are going to be razor thin. So when you think about deficits, that's a constraint. But then there's also what's happening in the bond market. Rates have been rising. Deficits as a share of GDP are double what they were in 2016. So the idea that either candidate is going to get everything on their wish list, I think, is a limiting factor with respect to how this could pan out for inflation and for the economy.
Is there a sense of sell the rumor by the news when it comes to the bond market, that because of what you said, it's going to be difficult to enact anything single-handedly, that yields are going to come back down and realize that any extra premium that they put in, regardless of who wins, is going to come out?
Yeah, there's in the last several weeks, there's been a certain fear factor in the bond market with rates rising. We thought that when rates had gotten down on the 10-year to around the 365 level, that it was fully valued. And so we were advising our clients to not get too far over their ski tips in the bond market. We thought rather that we would want to extend some duration, but really out into the belly of the curve, not further out the curve. We've had that backup in interest rates, and I would say continue to leg in here at these levels, but not to the point where you're overextending on duration. Because the thing is, with the election result, if you get a Trump victory, I think the odds of a bear steepener, yields rising on the back end more than on the front end, I think that's pretty likely. But under a Harris administration, it's more likely to be a bull steepening. Either way, you're not doing as well out the long end. But the key here is that in bonds today, you're getting 4.25%, 4.5%. If you're looking to investment grade bonds, you're in 5% land. That's a gift compared to the last election or the election before that.
A lot of people who come on the show agree with that and seem to have the same kind of idea about a bear steepener or a bull steepener, but a steepener nonetheless. Where there's less conviction is about the relationship with the dollar, overlaid on top of all of this. Yeah. Will higher yields and some of the agenda items that we've heard from a Trump administration in particular lead to truly a stronger dollar?
I think what we need to consider here is the short term versus the longer term trajectory. We've seen today some news out of the Bank of Japan talking about over the longer term lifting rates. China is working to resuscitate their economy. The U.S. is in a position where over the next year we should be expecting rates to come down. That's what the Fed is telling us. There's been some question as to how much that comes down, but next year rates should be lower. That, I think, altogether augurs for a dollar weakening, and it is at the sort of upper end of its historical range. So I think it's expensive and should cheapen, but on a Trump victory, I think initially, if there's some safe haven flows, that would benefit the dollar, but only on a short-term basis.
Kurt, we've got a lot of work to get through next week, that's for sure. It's good to see you, sir. Kurt Reiman there of UBS. Just starting that conversation on the difference between what we see in the data around a table like this and what you see in the politics. Markets have to speak to the aggregate. The politics are speaking to the disparities, the bifurcation amongst the consumer. We saw that from Bloomberg Economics yesterday. They broke down consumer spending. The main growth driver that we saw pop up in the GDP report yesterday has been narrowly boosted by upper-income households, with lower income ones who have grown more price sensitive. And that's where that anxiety comes from. We're talking about prices going up less fast. That's what we do around this table when it comes to the bond market and Federal Reserve policy. Everyday people living in this economy at the moment are still thinking about a price level that is materially higher than it was 5 years ago.
And they're reminded of it, as Kurt said, when they go to potentially pay their auto loan, or they go to pay their rent, or they go to the grocery store. And that's the issue. Those prices are not coming down, even though the rate of how much they're going up is.
Which is why that conversation is still very, very different on the campaign trail versus, say, Wall Street. Equity futures right now on the S&P 500, just a little bit softer. We're down by 0.75%. Weighing on this market this morning, earnings from big tech. We've heard from Microsoft and Meta. A little bit later on, you'll hear from Amazon and Apple. Looking ahead to all of that, we'll catch up with Darrell Cronk of Wells Fargo, Evan Roth-Smith of Slingshot Strategies, Pierre Ferragu of New Street Research with a few things to say about Apple. And we'll catch up with the latest coming out of Blackstone with a big push to build out data centers for mega cap tech. How those two worlds collide in just a moment. From New York, this is Bloomberg.
Investors have strong views that are being very lightly held.
Higher rates have not caused as much economic weakness as anyone thought.
If you take a look at the low-end consumer, that is where you're seeing a lot of this weakness show up.
There's a lot of signs of disinflation right now.
We have supply coming online. We have productivity higher. This really is good news.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Closing out October, where did that go? Here are the scores this morning. Equity futures on the S&P 500 down by 0.7%. On the Nasdaq 100, we look a little something like this. We're down by almost 1 full percentage point. Thank you, Meta. Thank you, Microsoft. Those two names down in the pre-market. A little bit later, we'll hear from Amazon and we'll hear from Apple. Microsoft down 3.5, Meta down by 3.4. If you get to the bond market, the scores on the month, what a move we've seen. 50 basis points higher. There and thereabouts at the front end and the long end on a 2-year and on 10s. Yields down this morning by 2 or 3 basis points. 427 on 10s, 416.82 on 2s. And later this morning, 90 minutes away, Lisa, jobless claims.
Yeah, at a time where there's really a sense that every economic data point has been surprising to the upside, which has really fueled this move. There is a real question that has started to percolate among investors, which is how high is the bar for the Fed to not cut next week, especially given such a fraught circumstance that they're going to be meeting in.
When you look at the ADP and then potentially the jobless claims, and then depending on what happens in this payrolls report, if it's not on the lower end with Bloomberg Economics, -10, it's on the higher end, you get the surprise, and we have a U.S. presidential election and potentially no result when the Fed meets. I think the bar is relatively very high, considering the fact they already cut 50.
The median estimate in our survey just coming down just a touch, if you want a sneak peek. 110 yesterday. That median estimate's down to 101. The high's still the same, 180. The low's still the same, -10. But the median's dropping back to 101 going into tomorrow.
Yeah, although some people saying that the reason why job openings, and the reason why I flipped to job openings is because this is partly because you could read the job openings any way you want. You could probably interpret in that the labor market is getting a little bit more calcified. But one of the reasons why the job openings have come in is because people were hired in such big numbers last month. So taking out the mess, taking out the hurricane disruptions and the strikes, there's a question of whether we're just reaching this point of stasis, of not much movement, and it could go one way or another.
Hoping we clear some real event risk over the next week. Equity futures on the S&P down by 0.7%. Coming up this hour, we'll catch up with Darrell Cronk of Wells Fargo on disappointments in big tech. We'll speak to Evan Roth-Smith of Slingshot Strategies as Trump and Harris hold dueling rallies in Wisconsin. And Pierre Fargo of New Street ahead of Apple earnings later on this afternoon. We begin this hour with Meta and Microsoft weighing on stocks. Amazon and Apple set to report after the close this afternoon as equities remain on track for a 6th consecutive monthly gain. Darrell Cronk of Wells Fargo writing, strength looks durable and sustainable. The key will be to maintain some semblance of stability in the 3 E's, earnings, elections and employment. Darrell joins us now. Are you seeing that stability, Darrell? Good morning.
We are so far. I mean, to the conversation that just happened, right? You can draw your employment piece any way you want to, right? I mean, to the point of jobless claims, better, ADP better. But if I also took JOLTS earlier this week, terrible. If I took Beige Book, bad, right? So there's a dichotomy there, which we face and we've been facing for quite some time. I mean, on the earnings front, we think the quarter ends somewhere around when the dust settles around 5 to 6% earnings growth, which is above the 3% we walked into, but certainly probably underwhelming. You get 49 companies today, which is 10% of the S&P market cap, 10% of the companies and 17% of the market cap alone today. Right, so it's going to be a busy day, not just within tech, which we're highlighting the Mag 7 and all that, but beyond that, we get to see a lot of good data today.
Well, two names are responsible for the bulk of that percentage. We're going to hear from the likes of Amazon and Apple.
Right.
How high is the bar for big tech based on these price moves this morning off the back of the earnings from yesterday?
I think it's pretty high. I mean, the reality is, if you backed out and looked at big tech, this will be the weakest quarter of earnings growth in the last 6 quarters, right? Now, again, still robust, but you can look at the dichotomy. I mean, simply look at what's happening even within tech. Google strong on cloud services, AMD weak on chips, right? So you get this really, intense bifurcation that's starting to separate those. And what's really, if you even broaden it out beyond tech, what's happening in the stock market as a whole is the double beats, right? If you beat on sales and beat on earnings, your stock price is killing it, right? You're seeing 5, 8, 10% moves, right, in a single day. Obviously a double miss, right? Same, symmetry to the downside. So the moves, right, as we separate kind of the haves and the have-nots, or the bifurcation, to use that as the word of the day, seems to continue not just in the delivered sales and earnings, but in the price action.
This is something that Julian Emanuel pointed out, too, that just the magnitude of the single stock moves on beats or misses really has been notable. I wonder what your takeaway is from that. Is that healthy? Does that indicate stock picking, or does that indicate that people really just have no idea and they look and expectations are where they are and people are kind of willing to sell or buy on a trigger finger?
I think it's an indication, a little bit of extended positioning, right? So positioning has been obviously robust, strong. Everybody's out a little bit on the bullish side over their skis, so you've had to calibrate that, back. And I also think it's really, it's as it always is in earnings season, it's incumbent on the outlook, right? So if you're not providing good transparency and a good outlook number, your stock price is getting hurt badly, right?
When it comes to sort of these specific stories, I wonder how long it takes until we get some sort of macro overlay. And I think of big tech as being the macro overlay that led to so many of the gains that we have gotten so far in the stock market. Can the stock market continue to gain if it loses that pillar for a fundamental reason?
Yes, it can, because you're starting. We've seen the breadth widen, right? So financials on an absolute and relative basis are doing extraordinarily well. Obviously, on the back of the steepening yield curve and what's happening with interest rates, industrials are probably the best performer on the board, right, on a relative basis. So tech has actually stepped back. If you look at the 11 GIC sectors on a relative basis, tech probably falls in the 7-8 category today as far as leadership goes. And so it already has stepped back. Now, what it can't do is decelerate materially, right? And I think the real, where people are holding tech, to John's point earlier, feet to the fire, is they want to see where that next incremental growth is going to come from. Like, we've priced in brought forward a lot of the AI, we've priced in a lot of the CapEx spend that's going to happen in 2025, because we know that number this year was 40 to 60% across the board on CapEx spend in the tech world. Next year, it's probably 30 to 50. It's down, but it's still robust. But if you don't monetize that, right, into incremental revenue, then I think tech does struggle to lead. And you've seen that in the multiples. So the multiples have come from 31 times in the summer on the sector back down to 28. You had a 3-point contraction, in the last probably 90 to 120 days.
So we hit 2 out of the 3 E's, earnings, employment, the election. You think we have any semblance of stability when it comes to the U.S. election?
Probably not, to be honest, Anne-Marie. I mean, I do think what you're seeing is obviously, and it's been well documented, you guys have talked about it many times, the Trump trade, right? Smalls outperform, rates up, inflation expectations up, gold outperforming, dollar outperforming, emerging markets weak, right? China, Mexico, all that stuff. I think if you end up with a red wave, right, I think U.S. exceptionalism continues, right? The globe struggles, right? Global trade policy, which you cover well, becomes very transactional, right? It's Taiwan, you need to pay for your defense. Europe, you need to chip in your fair share. We need to go resolve, conflict by conflict. Russia, Ukraine is how the administration, I think, will try to tackle global trade and policy outside of the tariff issue, which again has been well documented.
But you don't think exceptionalism continues with a Harris administration?
Not as much, right? I
think even though the rest of the world is weaker?
I think that the rest of the world's weaker on a relative basis, but not to the extent you would see out of that red wave, right? I think you'd really push it to the tails, right? So in other words, if there's a red sweep on Tuesday, I think you have to think about China's woes, Europe woes getting worse, right? Because you're going to limit their ability to export goods, right, through the tariff mechanism. You have to think about the nearshoring of Canada and Mexico that's been happening the last few years. As we think about, we need to renegotiate, all of the North America trade agreements, which will be on the table with a red wave. So I do think the globe gets weaker on a relative basis under a red wave. It stays weak under Harris, but not as weak.
But exceptionalism within the U.S., yes. Is that going to be very hard if there are tariffs and inflation does go up and there is a constraint on immigration and it starts hitting the labor market?
Yes. I mean, look, I mean, you guys know well, tariffs at their core are friction into the global trade system, right? But I also think people fear it worse than it is. If you actually just run the numbers, right, and you say, okay, let's take China, right? Today, the average tariff on China is 19%. We import about $430 billion from China. So if I take it from 19 or call it 20 to 60, it ends up being about 8/10, 9/10 onto inflation. So it's inflationary, but it doesn't tip the boat over type of thing. Same thing on global trade. If I take 10% on global trade of 2.7 trillion, right, there's real numbers there. So you can back into the math to understand what the economic impact's going to be. And I don't think it's quite as bad as people have extrapolated.
Darrell, let's wrap it up. Stocks and bonds. Middle of this year, you preferred large over small, DM over EM. You weren't chasing small caps. Your 10-year call, 450, is looking pretty good from the middle of this year. What's the stock and bond view now?
So I would say semi-stable on stocks. So if you roll out to year-end 2025, we're about 6,300 on the S&P. So decent return. The pound-the-table trade we've been trying to get our people to pay attention to is now's the time to take the bite at duration, right? Somewhere in the 430, 450. A lot of people were gnashing their teeth because they missed it in the summer months when the 10-year was down at 360, right? And they thought, the Fed's going to keep cutting rates and, the curve's going to just shift all the way down. And I missed my opportunity, and reinvestment risk is real, right? Because we haven't had to deal with it since 2006, basically, in a 15-year zero interest rate environment. So we're trying to tell people, look, don't be asleep at the switch, right? Don't crowd all your money to the short side of the curve. Start biting on intermediate long duration. Maybe we go to 450, maybe 475, but not much higher than that.
You know how this works. It's the only sale an American consumer runs away from, a financial market sale.
That's right.
Bonds on sale.
That's right.
Year was 430. Your 10 years down 2 basis points. Darrell, it's good to see you.
You too.
Appreciate it.
Thanks,
Thank you,
John.
sir. Darrell Cronk there of Wells Fargo, looking ahead to next week. Just a monster week just around the corner in this country. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John, some more earnings to get through. Uber shares falling nearly 6% pre-market. It did deliver a record operating profit, but it had weaker than expected ride bookings. Uber also issued a more muted forecast for the holiday quarter. The rideshare app said it struggled with FX headwinds, which weighed on its rideshare business. Uber has also been investing in new offerings in recent years, seeking to transform itself into a consumer super app. Peloton shares, on the other hand, jumping pre-market 5.3%. The company named Ford executive Peter Stern as its next CEO effective January 1st. Stern will be charged with turning around the long-struggling fitness company. Peloton reported second quarter results as well this morning, including revenue that missed estimates. The Grammys are relocating. The Walt Disney Company won a 10-year deal to broadcast the awards starting in 2027. That deal ends CBS's more than 5 decades as home to the show. According to the statement, the Grammys will air on ABC and Disney's streaming platforms, including Hulu and Disney+. As part of the agreement, Recording Academy will produce multiple Grammy-branded music specials and other programming across Disney platforms. And that's your brief, John.
Got things to say about Hulu pricing. Save those things for another time, after the election. Up next on the programme, dueling messages to swing state voters.
Allowing Russia to go into Ukraine, October 7th, and Israel, all of these things would have never happened if you had a different president.
Donald Trump trying to keep us divided and afraid of each other. That is not who we are.
A conversation up next, live from New York this morning. Good morning. Equity futures on the S&P 500 just a little bit softer. We're down by 0.7%. Yields coming in 2 or 3 basis points, just trimming that monthly advance, 427.43. Under surveillance this morning, dueling messages to swing state voters.
Inflation that should have never happened. Allowing Russia to go into Ukraine, October 7th, and Israel, all of these things would have never happened if you had a different president.
We have an opportunity in this election to turn the page on a decade of Donald Trump trying to keep us divided and afraid of each other. That is who he is, but Madison, that is not who we are.
So here's the latest. The Trump and Harris campaigns making the final push in a series of swing state rallies with early voting well underway. Evan Roth-Smith of Slingshot Strategies eyeing opportunity for Harris in the final days of the race, writing the decisive voters in the final stretch of this election are left-leaning people in right-leaning environments. Evan joins us now for more. Evan, good morning. So we're chasing a few 100,000 voters, as you suggest, across just a handful of swing states. Just elaborate on what you said there. Chasing left-leaning people in right-leaning environments. What do those people want to hear?
So we dialed in our last round of polling on the only people who really are casting decisive votes, right? People who are undecided or who could conceivably change their vote between now and the election. And what we found is that a lot of them are, as we say, they're people who are sort of inclined towards, they usually split their tickets, but they're a little more Democrat than Republican, but they are surrounded in their lives by Trump supporters. They say most of the people in their lives are Trump people. So these are, the one Democrat at the Thanksgiving table kind of situations. And are they going to break from their family or, the people around them? Are they going to vote against sort of their environment? And we haven't released this yet. This is coming out today. But we found a lot of them are Obama-Trump voters. So that's who's really left on the table. And they're cross-pressured on all sorts of policy preferences. They're anti-immigration, but they're pro-choice. They don't like corporate greed, but they also don't like government spending. So they have a lot of pressures working on them. And 60% of them, when we ask them, what the heck are you waiting for? What do you need to hear to make a decision? A lot of them just say, I just like to wait. I just like to wait until the last few days. And that's what they're doing. They're waiting.
Who do you think they're going to break for?
I think Harris has. It depends on how they close, how these two candidates close. The in-person rallies where they go in the last few days actually has a lot less to do with it. These voters are more internally focused in terms of their decision than is Donald Trump in the zip code next to me or Kamala Harris in the zip code next to me. Harris, if she closes on the economic message, I think has a way in. If she closes on something a little more nebulous, these are not voters who vote on democracy necessarily or January 6th or anything like that. If she closes on something more nebulous and Donald Trump closes strong on immigration or safety or some of these other, crime, these kinds of concerns that these voters are very sensitive to and more aligned with Republicans on, he'll do well.
Let's talk about where the candidates are going, though. Mm-hmm. Donald Trump is going to New Mexico. Mm-hmm. We've never seen New Mexico vote for Republicans since Bush years, 2004. Mm-hmm. And then he's going to Virginia this weekend. Do Republicans think they can actually play in these states?
I have no idea, but I'm very glad that they are making these choices as a Democrat. It doesn't make a lot of sense to put him there. Again, if it were for a rally or a show or some, or for a podcast, something with mass impact, I'm not quite sure why he's in these places. Harris is basically living in the swing states, but whether it really makes a difference, as I said, it comes down to just a handful of votes.
Okay, so the closing argument you say it comes down to, how much did Biden undermine her this week?
It didn't help.
And then Trump went off and made a meme about it.
Yeah, and Trump's doing this garbage thing. Again, but the only people who are really strongly reacting, Joe Biden is reviled. These swing voters, again, this data is coming out today, so.
Sneak peek.
Yeah, sneak peek. But these swing state swing voters, Joe Biden is minus 45 favorability with swing state swing voters. So it's not like they were waiting on the final word from the president to decide how they were going to vote. And Donald Trump doing the Donald Trump show isn't going to persuade them either. Now, if I'm Donald Trump, I am probably still more concerned about the Puerto Rico impact of my comments. In a state like Pennsylvania, there are 500,000 Puerto Ricans. Joe Biden won Pennsylvania by 80,000 votes. Don't love those numbers, right? If I'm Donald Trump.
I want to just dig into that comment that Joe Biden is reviled. Mm-hmm. How well or not well has Kamala Harris really distinguished herself from him? And at this point, her response to that whole situation was, look, he walked him back, but that's not how I feel. Is that enough?
I wish she had hit it harder. I don't think there's much left between now and Tuesday where she can redefine her relationship to the president. All of our research showed strong distance would have been better. They never really got there. This week about when she was responding to what he said about garbage or whatever he was trying to say about garbage, she sort of drew the distance, but that's kind of where she's always been. She's sort of drawn the distance. Wish she had done a little more of it. Maybe would have helped her. Again, when we look at these voters, it's the people who are going to decide this election as of today have not made up their mind yet. They will make it up over the weekend, or they will make it up in the voting booth, or they will see one ad on Monday morning and go, that's my guy or that's my gal, right? It's just how it's going to break.
So last night I was in an Uber going home, and the guy was listening to Hot 97, mm-hmm. and the radio host was saying that he's going to stay home because he's just not feeling it. How much is that something that you're hearing quite a bit?
I hate to get turnout projections and playing the early vote game or the the cab
That's
driver
what we
anecdote
do.
game.
Yes,
right,
well,
right. I mean,
come
what
on.
else is there to do at this point? But
Stop calling out our
get on a
game.
bus and
Let's
go knock
go.
some doors, right? But it's hard to know. I mean, I think there are pockets. I know that's a terrible answer, but there are pockets of voters that will be extremely activated, right? There are voters who are going to be less activated. And by the way, Donald Trump's strategy, basically, I mean, they've done some work to try and expand their coalition a little bit, but basically, he gets 47%. There's 53% of the country that's not going to vote for him. You just have to make sure that 53% doesn't all coalesce around one person. And if some of them stay home, great, that's a win also, right? So that's still where they are. Having a lower turnout election, there's now some contravailing evidence around what lower turnout voters might do in this election. I still think Donald Trump benefits from a low turnout election.
Interesting.
Yeah.
One candidate's got to lose, to state the obvious. But what's interesting about this is that candidate's probably not going to run again. Donald Trump's going to be too old. It's going to be unlikely they give Kamala Harris another shot, given the fact that she was gifted this opportunity and failed in the primary last time around. I think the really interesting conversation next week is going to be how these individual parties pick up the pieces and think about the future. What you said in this conversation that stood out to me is that swing state voter that doesn't fit into that neat ideology, that they are pro-choice but anti-immigration. How does the Republican Party or Democratic Party pick up the pieces and explain to the population what they're going to be in the future? Perhaps that is a difficult one, much more so, I think, for Republicans post-Trump than it might be for Democrats. But how are you thinking about that beyond next week?
Well, if Trump loses and accepts a loss or eventually accepts a loss, I mean, what will happen inside the Republican Party is going to be a bloodbath. I mean, you will have traditional conservatives trying to reassert themselves. You'll have people like J.D. Vance, who are now paragons of the Trump movement, try and retain control. His sons will probably try and retain control. His relatives who are running the party. That's really messy. If the Democrats lose, I mean, our question, it will also be very messy. No question about it. But the Democrats did a pretty decent job of sort of trying to move the party a little bit towards the center over the last year. We wound up with a messenger. Kamala Harris is sort of an uneasy messenger for Senate. She's a California senator. She is a pretty dyed-in-the-wool liberal. She was comfortable pivoting left in a way that not every candidate. Joe Biden didn't pivot as far left as she did in the 2020 primaries. But the question is if the Democratic Party can sort of stay on target with this slightly moderated positioning on fiscal policy, on immigration, if we are a little more muscular about taking credit for our economic policy, right? I mean, the economy, low inflation, full employment, approaching 3% GDP growth. We're not allowed to say it, but the economy is incredible.
On paper, but it's not what people feel.
No, it's not what people feel, but on paper.
But isn't that the problem with voting?
Yes, that's the problem. But it's also about leadership and being able to say. I mean, if Donald Trump were president right now, he'd be like, "This is the best economy in American history," right? And he'd be pretty close to right.
Why don't they message that better?
Because Democrats are poor messengers on the economy.
This administration has been shocking at it. And we've said it repeatedly on this program, and I can compare and contrast the two administrations, being here in America through both of them, that the access you used to get to the economic speakers from the Trump administration was constant. It was every single month. You barely hear from this administration. And I think that's been to their detriment. I think about some really strong payrolls reports, whereas you say if it was Donald Trump still in the White House, we would have had a Rose Garden address, balloons. On a day like today, we would have had pumpkins and a Halloween party.
It would have been a party.
Right? And we just haven't seen that from the Biden administration at all.
I wonder if they try to bury it because they know people are still so concerned with inflation and they can't say in their face, well, this data is really good because they're not feeling it.
Possibly. Evan, a lot to think about for the future as well. This was really insightful stuff. Appreciate your time. Thank you, sir.
Thank you.
Evan Ross Smith there of Slingshot Strategies. Up next on the programme, we'll catch up with Pierre Ferragu of New Street with Apple set to report earnings after the close. From New York, this is Bloomberg. Equity futures right now pulling back by 0.7%. There's a big tech effect this morning. We'll get to those single names in just a moment. On the Nasdaq 100, we're negative 0.9. 2 hours away from the opening bell. With your morning movers, let's cross over to Manus Cranny. Morning, Manus.
Jonathan, a very good morning to you. I know we can't throw everything into the monolith of everything is tech, but 24 hours after Alphabet talked to you about the efficiency of AI and what they're doing. This morning, we see Meta down 3%. This stock is up 67% into this opening trade. We have a conundrum. They're going to raise the capex. Okay, they've raised the lower guidance on capex, but they've also told you that advertising is 96% of the revenue numbers here. Revenue there is going to slip ever so slightly. So that differential is something you need to keep an eye on. Yes, AI, you're spending 8% more time on Facebook, 6% more time on Instagram, but it is about, trust me, we will show you the path forward. Roll it over and have a look at Microsoft. We have a constraint in our issue here. This is capacity constraint in AI. The current quarter, you're going to see cloud usage slip, or the cloud revenue drop to 33 to 33%. That's down from 34% in the first quarter. So we have a capacity constraint. What do? Throw more money at it? Build more data centers? That's the issue for the market in terms of solving that capacity constraint. Satya Nadella says this business is going to be the fastest growing business in our history. The pace and the size of that. I leave you with MicroStrategy, a software company with a Bitcoin twist. The stock is up 1 1/8 this morning. By the way, 291% so far this year. This stock actually outperforms NVIDIA. Why? Because they have a lumpy position in Bitcoin, 18 billion. But they're going for a capital raise today. It's called an at-the-money equity raise. In other words, pretty much at the stock price at the moment. They're going to raise $42 billion. And guess what they're going to do? They're going to buy more Bitcoin. But I'll leave you with the thought. The business, the business that they do, well, no, the software business actually fell by 10%.
What a shocker, Manus. What a shocker. Appreciate your time this morning. Manus Cranley there with some movers this morning. Under surveillance, let's recap some of those names. Meta and Microsoft, both trading low in the pre-market. Meta vowing to spend big on investments and new technology. Microsoft slipping on lower forecasts for cloud revenue growth. Later on this afternoon, more Mag 7 earnings. We'll hear from Amazon and Apple. Microsoft, let's talk about CapEx. If you are just joining us and haven't been through these numbers, quarterly CapEx at Microsoft, almost $15 billion, a record, up 50% from the same period a year earlier.
And that once was a great thing because a lot of the tech giants were saying that they can't invest enough in the AI behemoth that is becoming an incredibly dominant theme. And now there's a question of show me the money. The fact that the cloud forecast came lower was a big concern for a lot of people, especially given what we saw from Google, which was the opposite. Now over to Amazon. What does our AWS platform do, and how much do they see real gains in traction?
We've heard from these tech CEOs before. The biggest risk for them, given the trend that they're anticipating and the power of that trend, is underinvesting and not overinvesting. And I think we saw evidence of that yesterday, constrained by capacity over at Microsoft. And we've talked about this a few times. They're also constrained by the patience of the investor base to carry on investing at this rate. And at some point, they're going to have to show something for it and show a whole lot more for it to encourage that patience to remain, to hang around and keep investing in that equity.
As I was reading through the Meta results and the Microsoft results, it strikes me that Microsoft is coming off a really high bar that Google set, and they didn't really meet that incredibly high bar, but they're still delivering. With Meta, there is a concern about doubling down on investments that are still losing money. And that, I think, is sort of a different characteristic, and it shows how specific people are getting with these stocks.
The stock recovering just a little bit. We're down about 3% in early trading. An update on the politics. Donald Trump doubling down on President Biden's garbage comments. Trump staging a photo op in a garbage truck, wearing a safety vest. Kamala Harris continuing to distance herself, saying she strongly disagrees with any criticism of people based on who they vote for. Quite the scene yesterday afternoon.
So I don't know if this is going to land, but I do look at Politico when they do Who Won the Day. These days are so critical and they're so important. What we heard from Evan just a moment ago is that those undecideds are going to make their decision, maybe even when they wake up on Election Day, because they have different issues that they care about in both camps. So when you look at Politico Who Won the Day, they say Trump won because he forced Harris to do cleanup. Harris had to go out and clean up Joe Biden's comments on garbage, and then he changed the subject and basically made a meme of it that was viral. So even if you didn't know, why is the former president in a safety vest? Why is he sitting in a garbage truck? You're probably forced to Google it and then realized, oh, he was poking fun and doubling down on what the White House was saying.
Harris is between a rock and a hard place. I've heard complaints about she should do more to distance herself from the president. Can you imagine if she did? If she did, she'd be accused of being untrustworthy and disloyal. And that's why it's so difficult to run as the vice president of this administration at this time.
This is the reason why she hasn't really divided herself as much from Joe Biden, and something that a lot of people are saying could hurt her chances with a lot of swing voters.
That's the latest on the politics. Here's the latest from the automakers. VW laying out a plan to avoid factory closures in Germany. The company saying measures include a 10% pay cut and revised bonus system. The next round of talks between management and Labour leaders is set for November 21, ahead of possible strikes at the beginning of December. That stock just a little bit softer intraday.
And it talks to really this question of, kitchen sinking it and basically talking about all the woes to then get that 10% pay cut that they're talking about and a revised bonus system. A question of, will they finally get the leverage to make the moves that they need to in order to be viable?
It's a negotiation taking place, and we've seen the back and forth publicly over the past few weeks. Let's turn back to big tech. Results from Amazon and Apple coming after the closing bell. Pierre Ferragu of New Street Research maintaining a neutral rating on Apple ahead of earnings with a $225 price target. Pierre joins us now for more. Pierre, looking forward to these numbers dropping a little bit later. Just share your thoughts with us on how the new iPhone is doing, what you're seeing just in terms of sales relative to the same kind of thing from last year with a new product.
Hey, John. Yes. So we are just like in the very early innings of getting feedback from the market on how the iPhone is doing. As we were expecting so far, the feedback we get is pretty negative. We already hear about weak consumer reception and Apple poking on cutting orders with their supply chain, but it's still very early. What we expect usually is like late November and early December, that news flow to accelerate and more evidence of that coming. And of course, if Apple has to make like a significant adjustment to its supply chain, it's going to become very tangible and material in the first weeks of January. But so far, what you see is that Apple has gained a lot of market share in China. It's now reversing with Chinese manufacturing coming back into the higher end of the market. What you see is like a consumer demand across the world. You just mentioned like the demand in the auto industry being very weak. So you don't have a lot of consumer spending. And last but not least, the big focus in terms of innovation of Apple this year was Apple Intelligence, introducing AI features to the phones. And what we see is that these features, even if they are like the right direction of travel, are unlikely to have a significant impact on consumer preferences in the near term.
Pierre, a lot to unpack there. Can we just pick out the geographic piece of it? You mentioned China. Is there a read across from the struggles of luxury, the likes of LVMH, to an Apple in China at the moment? Is that the wrong way of looking at things?
Yeah, that's an interesting one. When you look at it globally, it looks like consumer weakness tends to be more in the lower end of the market and the higher end of the market being better protected. And that's what we saw in the feedback. Like the weakness of the iPhone 16 is more like in the non-Pro models. In China, you have potentially a different situation. You mentioned the data points of LVMH indeed, where maybe the higher end of the market could be slowing there, but it's still very early and would probably be more specific to China.
How much are you seeing the bar as being lower for, say, an Apple than a Microsoft, than a Google, than even a Meta, just simply because there has been so much angst really about how it's going to deploy AI and whether it can really get some sort of upgrade cycle going?
Yeah, it's a good question. I think you have like a lot of excitement around AI, and AI being deployed by Apple came through over the summer. You saw the stock reacting to that very significantly. And quite interestingly, expectations are very non-tangible, intangible. People are excited about AI, but nobody is really hanging onto a specific feature and to any sort of killer app. And you see a very similar situation at Microsoft, where Microsoft is doing quite a good job actually at putting like Copilot in the hand of their users. They seem to be also doing already quite a good job at monetizing it and charging for it. And the feedback from users is very ambivalent. On one hand, it says, well, it's not really useful, it's a bit disappointing. But on the other hand, they stick to it and they're like, yes, it is AI, so I need to get used to it. And I'm actually, even if it's a bit disappointing, I'm using it every day. So that's really this ambivalence that you feel everywhere, where everybody wants to hear about AI, everybody wants to try AI, but nobody is really coming up with very, very strong evidences of a killer app that could, makes the picture clearer to read.
A lot of people are talking also about Apple as sort of the underdog when it comes to people truly understanding their services revenues. Is that going to be something that will surprise yet again as one of the major drivers? There was a time when people thought this would ultimately be a services company.
So that's like, I think if you look at Apple and AI in the medium term, over 3 to 5 years, I think that's the right way to think about it. Apple has done a very good job at leveraging its user base to create additional, very high quality, high profitability, and very recurring service revenues. And as the AI use cases are getting a bit clearer, Apple will have a very fantastic distribution power, the ability to put AI in the hands of users, and they should be able at some point to charge for it. But I don't think the technology is ready for that yet. I don't think you have enough of a high value AI use case for Apple to start charging on a monthly basis for it.
Pierre, I know we talk a lot about China and the potential growth impact this is going to have on Apple, but recently the former president told us Tim Cook called him to complain about the European Union. How much are those potential financial penalties weighing on Apple and Tim Cook?
Well, financial penalties for Apple are not never a significant moving part. It's a very, very large and very profitable company. So, when you compare the risk of these penalties to the market cap of Apple, it's very insignificant. And then indirectly, we know that it's very unlikely that any jurisdiction in the world, including the European Union, could really take, steps that would materially hurt Apple's business for a very simple reason. Apple has a very strong bargaining power because consumers like their products a lot.
Hey, Pierre, looking forward to the numbers when they drop a little bit later. Pierre Ferragu there of New Street Research. Apple, after the closing bell. Equity futures right now on the S&P near session lows. We're down 0.7%. With an update on stories elsewhere, here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Israeli Prime Minister Benjamin Netanyahu will talk with White House senior Middle East envoys Brett McGurk and Amos Hochstein about brokering a truce in Lebanon today. The latest plan calls for a 60-day pause in fighting to ensure that Hezbollah doesn't receive any more weapons from Iran and moves further away from the northern Israeli border. Hezbollah hasn't signaled yet whether it is interested. Taiwan suspending trading on its $2.5 trillion stock exchange on Thursday. Powerful storms making its way towards the island. Super Typhoon Kongray has intensified as it skirts the Philippines and tracks towards Taiwan, where it's expected to make landfall Thursday afternoon. It's the third storm this year to disrupt stock trading. Taipei is also shutting offices and schools. Elon Musk is due in a Philadelphia court at 10 a.m. Eastern this morning. Musk must attend the emergency hearing to address a bid by the city's top prosecutor to stop his super PAC from awarding $1 million prizes to registered voters who sign a petition supporting the First and Second Amendments. The lawsuit alleges Musk of illegally trying to influence voters in the presidential election. And that's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, mega cap techs, capex boom.
It's clear that there are a lot of new opportunities to use new AI advances to accelerate our core business that should have strong ROI over the next few years.
That conversation just around the corner from New York. This is Bloomberg. Live from New York City this morning. Good morning to you all. A snapshot of the price action cross-asset equity futures on the S&P. Just off session lows, we're down 0.7%. The earnings from Microsoft, the earnings from Meta, just weighing on this market just a touch. In the bond market, yields trimming a monthly advance. We're down a basis point or two on a 10-year. On the month, we're up by around 50 basis points, 428.44. Under surveillance this morning, mega cap techs, capex boom.
It's clear that there are a lot of new opportunities to use new AI advances to accelerate our core business that should have strong ROI over the next few years. So I think we should invest more there. And second, our AI investments continue to require serious infrastructure, and I expect to continue investing significantly there too.
So here's the latest. Big tech ramping up spending to construct and rent the data centers required to fuel power-hungry AI services. At Microsoft, quarterly capital expenditures in the first quarter came in at $14.9 billion, a record, up 50% from the same period a year earlier. Blackstone's John Gray is positioning for the future. Our equity and debt strategies operate in multi-trillion-dollar markets that generate enormous flow of IG debt, often where Blackstone is the leading player, including data centers, energy infrastructure, and real estate. Michael Zawadzki of Blackstone joins us now for more. Michael, good morning. It's good to see you.
Thanks for having me. Great to be here.
Tech is in the news in a big way this morning. We're hearing from some companies that they are constrained by capacity. That means we're going to see a lot more spending through next year and maybe even beyond. Can you walk us through how you and the team are positioned to succeed in this world and how big this opportunity might be?
Well, I think this opportunity set is massive, right? And one of the great things about working at Blackstone is we're long-term thematic investors, and we try to spot these mega trends. And clearly, AI, energy transition, and infrastructure is one of those mega trends, and we play it on the private equity side in deals like QTS and our pending deal in Cronk in Asia on the data center side, but we're also doing it in credit. And the amazing thing is you have these long-term contracted assets that are fantastic for financing against, but also all the picks and shovels around it. A deal like CoreWeave, a data center infrastructure company, or Park Place, a services provider to that market, we can really take advantage of the entire ecosystem given the scale of our capital base.
What's the relationship going to be like with some of the major tech firms? What would that look like in years to come? Because clearly these companies don't want to become energy companies. They don't want to become real estate companies. What would that relationship look like?
Well, for us, it's becoming a financing counterparty against these long-term, high-quality assets with incredibly strong counterparties. And I think the ability to do that in scale and deliver what we call private investment-grade solutions to our clients, where they're getting excess spread for high-quality investment-grade assets, that is one of the strongest tailwinds we see in our business. Over the last 12 months, we've originated $38 billion of what we call private investment-grade assets with an A credit rating, but with 185 basis points of excess spread versus buying a liquid A-rated corporate bond.
Why go to the private market for this kind of financing?
Well, I think, Lisa, this is part of this long-term secular trend we see towards private credit. And what is driving it is this farm-to-table approach that we talk about, where we bring our investors right up to the borrowers. And in doing that, we can provide speed, certainty, customization, which is incredible for those borrowers, but it's also great for our investors because they can capture all the excess spread that comes with providing that specific and bespoke solution.
The reason why I ask is because typically I think of a Blackstone or an Apollo or an Ares as a company that looks for lower-rated deals and ends up earning outsized returns as a result of significant yield. The focus has been much more on investment grade. Why is the focus for a lot of these private debt and equity companies so much more on top-rated types of investment opportunities?
Well, I think there's three big reasons I see. Number one is the sheer size of the opportunity set. A lot of people talk about direct lending as the first inning within private credit. That's a $2 trillion market. This private investment grade opportunity set is $25 to $30 trillion. Second, it is so much earlier in its transition to private capital, maybe 1 or 2% penetration. And so you have a super long runway as we move towards this secular shift. And third, the mega themes that are driving it. We spoke about data centers. We spoke about energy transition. You have these incredible mega themes that are driving it. And that is what is leading to that solution set, which is super attractive for our clients who are looking at traditional fixed income markets that are at their all-time tight spreads post the GFC. And so the ability to capture excess spread without incremental credit risk in scale, that's what's creating the opportunity set.
I'm thinking back to the 70s when the high-yield bond market really financed a lot of the modern cellular infrastructure that popped up. I'm just wondering how much of this is entirely funded through companies and not at all connected to public financing. I mean, is this basically not predicated on any kind of public intervention, or is this often fueled by that type of activity?
Look, I think the healthiest capital markets come where you have both public and private, and this year, frankly, you've seen that, right? Even in a year where the public capital markets have been open, you've seen incredibly strong issuance. You've also seen private capital deployment. For Blackstone, we've had record year-to-date deployment in both our investment grade and sub-investment grade private capital businesses. And so this notion of a healthy capital markets requiring both public and private capital, that's one we fully subscribe to.
At a certain point, you have to wonder how much, and I noticed this with Blackstone, that credit was the leading and the biggest unit after really growing up as a private equity company. And it raises this question about a new model at a time where there are fewer mergers and acquisitions, whether it's for policy reasons or whether it's for transactions not necessarily being attractive enough to certain people. Is that the model going forward? The M&A is going to be suppressed, and there really isn't going to be the same role for the investment community that it used to have.
Well, I think when you look at what drove our earnings announcement on the credit side a couple of weeks ago, you had three important things. One, it always starts with performance, and we delivered nearly 17% gross returns across our private credit platform over the last 12 months, and our default rate stayed less than 50 basis points. Performance then drives deployment, to your question. We've had record deployment. We said in a release earlier this week that we've deployed nearly $40 billion deployed or committed in direct lending year to date. That is nearly double what we did in all of 2023. And then when you see strong performance, when you see strong deployment, that leads to strong flows. And that is why we're seeing our clients trust us with more capital increase by 20% year over year to about $432 billion across credit at Blackstone.
Michael, do you buy into this narrative, especially when it comes to things like M&A? People are waiting on the sidelines because they want clarity to next Tuesday's election.
Well, I think when you look at M&A, you have all the ingredients for an uptick as we look into 2025, right? You have a strong and resilient macroeconomy. You have cost of capital coming down. You have a lot of pent-up demand for slow exits over the last couple of years, and you have record private equity dry powder. And so all of that is fueling what I believe will be a strong uptick in activity into 2025. I think when we get past the election and some of that uncertainty goes away, hopefully that unlocks what we see.
You see that regardless of who wins?
I do, because the ingredients I mentioned around cost of capital, dry powder, pent-up demand, and a strong macro, fundamentally, I think those will be the drivers regardless of who wins next Tuesday.
It doesn't sound like financial conditions are tight. Why is the Fed reducing interest rates with that in mind?
Well, John, I think what the Fed is looking at is inflation data. And what we see in our proprietary data, we're fortunate to have access to so many portfolio companies in Blackstone, is that wage growth, while still healthy, is slowing. And importantly, shelter costs, which the Fed looks at on a lag, is coming down in our proprietary data. And so I think as inflation comes down to where the Fed is looking for it to go, I think that will give them air cover to take short rates down, and I expect to see that in the near term.
And perhaps again next week. Michael, really thoughtful stuff, just a massive opportunity and a big, big theme for big tech this morning as well. It's good to see you. Appreciate it. Thank you. Michael Zawadzki there of Blackstone. Equity futures right now just bouncing off session lows. We're down by about 0.6% on the S&P 500. In the next hour on Bloomberg Surveillance, we'll catch up with Anwiti Bahuguna of Northern Trust. We'll speak to Mandeep Singh of Bloomberg Intelligence with two tech names down in the pre-market that we need to get into just a little bit more. We've heard from Meta, we've heard from Microsoft. After the close, we'll hear from Apple and Amazon. Then we'll catch up with Seth Carpenter of Morgan Stanley as we count you down to payrolls Friday, about 24 hours and 34 minutes away. Before we get there, jobless claims just around the corner as well. So another read on the jobs market going into the big one tomorrow morning. And then we'll get the bond market reaction with Lindsay Rosner of Goldman Sachs Asset Management on a massive month for fixed income with 2-year and 10-year Treasury yields higher on the month by around 50 basis points. From New York City this morning, good morning. The third hour of Bloomberg Surveillance up next.
Betting markets have gotten way ahead of themselves. This is still a toss-up.
There's a lot of concern that a Trump administration would mean more inflation.
Trying to understand what's a press release, what's a meme, and what is actually implementable remains a big question.
Both parties have platforms to stimulate the economy.
Many of the big issues facing this country are going to be facing us no matter who takes charge.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
We are 90 minutes away from the opening bell and 30 minutes away from economic data in America. As we round out the month of October, your scores look like this on the S&P 500, down by 0.6% on a sixth-month winning streak, the longest since 2021. Nasdaq futures down by 0.75%. Weighing heavily on this market this morning, earnings from Meta, earnings from Microsoft. Those two stocks down in the pre-market. We're down 3 on Microsoft, down 2 on Meta. A little bit later on this morning, you're going to see some economic data in America. Initial jobless claims, the estimate 230, the previous number 227. We are at pre-hurricane levels. Throw in the ADP upside surprise yesterday, and it looks like dare I say this labour market looks okay?
If you get a labor market that continues to look okay, that continues to confirm that upside bias that we have gotten, and you get an upside surprise in the inflation read that the Federal Reserve looks at, how much does that potentially change the narrative about how much and how willing the Fed could be to cut just in general, but also next week?
Especially when we know that everyone has been saying the Fed's just going to have to look through this data because it is so noisy, because of the hurricane, too, on the southeastern states, because of what's going on with Boeing, more than 30,000 workers still on the picket line. Yet the data, for the most part, looks good. And it's the last employment report, not just for the Fed meets, but for the presidential election. So I think depending on how Friday looks, either campaign's also going to use it to their advantage.
We've been through these dates a million times, and we're right on the edge of it, on the cusp of a monster week. Payrolls tomorrow morning, onto the election next week, and 2 days later, an FOMC meeting. The estimates keep coming into our survey. The median estimate in our survey right now, 101. The range is wide, at the high end 180, at the low end -10. The previous number 254, 101K the estimate for tomorrow morning. Coming up this hour, we'll be catching up with Anwiti Bahuguna of Northern Trust with big tech earnings weighing on equities. We'll speak to Seth Carpenter of Morgan Stanley on why he thinks the Fed will cut in both November and in December. And we'll catch up with Bloomberg's Ed Ludlow looking ahead to earnings from Amazon and from Apple. We begin this hour with stocks falling following disappointing results from both Microsoft and Meta. Later this hour, we get the latest jobless claims numbers and another read on inflation. Anwiti Bahuguna of Northern Trust remains constructive. We expect to see a soft landing with strong economic growth, strong corporate earnings, slowing inflation, and a softening labour market. This scenario is historically constructive for equity markets. Anwiti joins us now for more. Good morning. It's good to see you.
Thank you for having me.
So do you just stay long the US equity market with everything given that you've just said?
Yes, and with a 12-month outlook, I would say that's still the case. I do expect some near-term volatility. There's a litany of events in the
We'll talk
next
about those
few
events
weeks.
in a moment, yeah.
Yes.
The election's one of them.
Election's one of them. I think it's important for us to also acknowledge that labor market's going to be noisy, and it's not always clear that people look through it. We hope they look through it, but things can happen.
When you say look through and noisy, does that mean look through weakness?
Exactly.
What if
yes.
it's strong?
Now, that is our biggest risk case, because that's one reason, Jonathan, we are underweight bonds in our portfolios, because that soft landing scenario, if that translates into sort of the Goldilocks scenario that we have seen so far, where inflation has continued to come down while growth has remained well above trend. If inflation doesn't come down, that's literally the only risk case that worries me a lot right now, because that ties the Fed's hand. Then you have slowing growth and sticky inflation, and that's not good for most asset classes.
Some people are arguing, though, that actually that's positive for equities. What you end up with is a situation where the economy is growing. It's basically hot. There's a no landing scenario. Yields, yes, are a little bit higher, but we've seen equities look through that. Why is that not the base case? Lean into equities as the hedge against inflation. Lean into equities as the hedge against non-regulation. Lean into equities if you think that the economy is going to be just okay and the Fed's going to cut rates. How much can you push back against that?
Yeah, and there is a range of inflation where it's still okay for equity. So if it's in the sort of what we call moderate 2 to 4% inflation range, equities can weather that. But the stickier point to me is, what if the Fed stops cutting rate at that time? And there's so much expectation of Fed rate cuts, right? And if inflation's higher, their hands are tied. That's one of their mandates. They are back to that environment where we're debating, well, where's the neutral rate? They should not be cutting anymore, or there, maybe another 50 basis points and you've reached neutral. Then, even though it's constructive in the short term for equities, because growth is so strong and they are more growth-driven assets, what happens when companies are not able to refinance at the lower level that they have been doing?
Just to sort of underscore what you're saying, what we have seen is a lot of volatility to beats and to misses when it comes to a lot of big tech companies and all of the companies that have been reporting. Have we reached a point where yields pressure companies to really outperform on their earnings? The earnings have to come in order to justify the differential in the earnings yield, the differential in some of the valuation metrics.
That's right. And on the margin, I would say it's still okay. It's not bothering. But the longer the yields stay higher, the longer the 10 years at, 4.25 now or so, the longer that stays elevated, those factors will come into play again.
You say ahead of the election you're advising your clients not to panic. Why do you think the market already is pricing in one scenario over another?
Yeah, that's a puzzle to me, Anne-Marie. All the polls I see are fairly close. I mean, within a margin of 1 or 2%. That doesn't give me enough confidence to have a strong view one way or the other on why certain sectors, certain stocks, for example, oil and natural gas, may be outperforming the solar and things like that. There is still so much unknown about exactly which policies will get implemented, exactly what legislation will pass, how watered down it'll be. And then I keep coming back to this one thought that people behave as if it's a single factor, single variable regression, but we are in a multiple variable world where it may be that we have less regulation and that's good for certain production companies, but we may also have massive tariffs and we still not clear what the exact macroeconomic impact of that on growth and inflation those may have. We may have immigration policies. So one needs to sort of wait and see how all of these interplay to panic.
You say also an upside surprise in the payrolls report could be the biggest risk, especially when it comes to the Fed. What if we get that and we don't have a decision on Tuesday and they meet on Thursday? It's going to be a lot of answers that they're going to probably not have when those reporters are grilling Jay Powell.
Yeah, that could be a hairy situation. But again, very short term, because we will get more clarity on election at some point.
But they look through all of that and just cut.
The Fed? Hard to say. I think the inflation number will be far more important than the volatility around elections.
A lot of people are making a big deal of the next week. I just really want to understand from you whether you think the next week has the real potential to redefine the macro outlook. Not just for the US economy, but for the global economy. You disagree with that?
Yes, absolutely.
Why do you push back so much against that?
Because if you look through and we did, 20 administrations of who was heading up on the top line, the president, the legislature, the combination of Republicans and Democrats, there is no clear pattern, Jonathan. What really matters is the macro environment. So was a Republican presidency under Bush bad? No, we had a financial crisis in 2008, and so all the risk assets look terrible. So there are other factors that we won't know next week. It's not that they don't matter, they do matter. But it takes 6 to 9 months to have clarity on policy, implementation, implications, and all these other variables.
You understand a range of outcomes, though. We could go from having a corporate tax rate that's at 21, could be 15, might be 28, 15 with conditions. We've gone from letting millions of undocumented migrants into this country to maybe deporting millions of undocumented migrants in the future. This could mean big changes for the way this economy operates, couldn't it?
Absolutely. Absolutely. And 100% would agree with that. And I think we will have clarity. Companies will figure out how to work through those different things. And what we need to stay focused on is how are the companies that we are investing in dealing through changing regulation, dealing through different interest rate environments, dealing through slowing or faster inflation, and these immigration policies, which will have an impact. They will.
I've got a good friend called TK who would say they will adapt and adjust in the future. They will adapt and adjust.
Yeah, well, and maybe they will, but it seems like right now corporate executives are not making big moves because they are afraid to go and adapt and adjust too quickly if the scene could change pretty significantly. So we shall see the adapting and adjusting.
Anwiti, it's good to see you. Appreciate your time. Anwiti Bahuguna there of Northern Trust. Equity futures on the S&P 500 recovering just a touch. We're down 0.6% with an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Shares of Norwegian Cruise Lines rising 5.3% pre-market. It reported better revenue and third quarter profit that beat expectations. Norwegian cited continued robust demand and raised its full-year outlook for adjusted EPS. The stock has rallied more than 19% so far this year through Wednesday's close. Hedge fund manager Pierre is returning to oil. In a letter to investors seen by Bloomberg, Capital Management said it's renewed a position in crude after quitting the commodity a few months ago. The change is due to, quote, our expectation of higher oil prices as a result of the ongoing conflict in the Middle East. He went on to write that he expects further escalation. Celebrations over the Dodgers World Series win quickly turned into chaos in downtown LA. Several stores were looted as riders launched fireworks in city streets, with reports of projectiles being thrown at police officers in the area near Dodger Stadium. A city bus was also burned to the ground in Echo Park.
Police ordered crowds to disperse before making a number of arrests in connection to the gathering. And that's your brief, John.
Danny, thank you. Now, I don't know, this is just what I was told, but I was told this is something Eagles fans do as well. they riot when they win.
Okay,
is
look.
that a thing?
Well, Philly fans, they are an interesting crowd. That's all I'm going to say.
Okay, really? You're going to just cast shade in Philly? I will just say.
I'm not.
It's just
I'm just
bizarre.
repeating what I was told.
Okay, you know, I've heard that at the Philly Stadium, they have a jail holding pen.
Is that what they do?
Underneath, yeah. I heard that that's the case.
They smash things when they win.
Okay. I don't get it either. I can't justify this. This is
Can't work
ridiculous.
this out. Looting.
It's the one outcome you know. You win or lose, there might be riots.
That's ridiculous. OK, up next on the programme, the Morning Calls Plus, we'll catch up with Mandeep Singh of Bloomberg Intelligence, looking ahead to earnings from Apple and from Amazon. That conversation just around the corner. Your scores this morning. Equity futures, negative by 0.6% on the S&P. Bond yields, a touch lower. We're down 2 basis points, 4.28 on 10s on 2s. Let's call this around about 4.17. And in just a moment, we'll get jobless claims in America. From New York City, this is Bloomberg. So here's the cross-asset picture for you. Equities right now negative by 0.6% on the S&P 500. In the bond market, just anticipating another read on inflation and another read on jobless claims in about 15 minutes' time. Bonds a bit, just a bit richer. Yields are lower, 2 or 3 basis points. The 10-year, 4.27.43. As we count you down to the opening bell, let's get you some morning calls. First up, Citi, raising its price target on Meta to 705. The analyst saying AI is driving engagement in Instagram and in Facebook. That name is down slightly now, recovering. We're down 1.9%. Your second call from Barclays also raising its price target on Meta to 630, saying artificial intelligence is improving the business. And just to turn to Microsoft, TD Cowen lowering its price target on Microsoft to 475, saying shares will be range-bound until capacity loosens and Azure re-accelerates. That stock is still negative by 3.4%. Let's stick with tech. Amazon reporting Q3 results after the market closed today. Analysts expecting to see that sales grew 10%, fueled by its cloud computing and advertising business. Mandeep Singh, charged with looking over all of this from Bloomberg Intelligence, joins us now. Mandeep, good morning.
Morning.
What are you looking for from Amazon?
Well, AWS, and that goes without saying, that's going to move the stock along with their CapEx guide. And what we are seeing, the common theme across all the big tech earnings is they're guiding to sequential CapEx increases. For some of them, it is translating into revenue. For companies like Meta, it's more about how it's improving their products internally. And that's the big difference. In the case of Amazon, their CapEx is getting distributed, in their delivery centers, as well as for the CapEx, the AWS CapEx build out, and they are investing in satellites. So their CapEx composition is very different from a Microsoft that is going all in on the generative AI side.
Let's talk about the numbers coming out of Microsoft. Yeah. They're staggering. What was it, 15 billion for CapEx in the first quarter?
Yeah.
This is up 50% in a single year. What's it going to be in 25?
And they called out GPU shortages. So the question you have to ask is, what are they spending $15 billion on, and why can't it fulfill their GPU needs? That's the part that I still can't reconcile, because they said there are other component shortages, power, everything is a constraint right now. But why would there be a GPU shortage when your CapEx is going 50%? Maybe NVIDIA is raising prices, we don't know, but that's the part which is, I think, bullish for NVIDIA. Clearly, every company, Meta called out 100K cluster. I mean, think about it. The biggest cluster so far was 25,000 GPUs. Meta called out 100K cluster that's currently there. So that's what these companies are doing, scale. And look, for a company like Alphabet, that translated into Google Cloud acceleration, search being steady. In the case of Microsoft, it was more flattish for Azure. For Meta, they didn't have any real separate AI revenue to show. And that's why I think the market reacted the way it did. For Amazon, I think the growth rate will probably be lower. You won't see an acceleration like you did with Google. And that's where I think Google was the big winner when it comes to this earnings.
Mandeep, I'd love to get your sense, just to dig a little bit further. Isn't this a good thing? And we've been talking about this. Isn't this a good thing for Microsoft, that essentially the only reason why their expected earnings from the cloud revenues isn't bigger is because of capacity constraints?
It is. And long-term, look, second half, if I model the second half and capacity constraints go away, then that Azure AI contribution, which they said it's a $10 billion business now, is going to accelerate. And that's where, we don't know what that second half is going to look like because the company guides very conservatively. They guided to some tapering in the second half. Meta last night said there will be a significant increase in CapEx. What does significant mean? 20% is already embedded in the consensus. Is it 80%? Is it 50%? And that's the uncertain part about the spend here.
Especially when you're not seeing monetization from some of the other sort of augmented reality efforts, et cetera. How much is that kind of weighing on this idea of how much do you have faith in Mark Zuckerberg, the truly frugal, the truly cost-cutting executive?
I mean, you would bet they have learned their lesson with what happened, with overhiring in 2021, the spend they did in 2022, and really the correction they had to go through. So I would be very surprised if, there is a repetition of overspending here. But clearly, nobody knows the extent of scale you need when it comes to these Gen AI investments. Everyone sees the next version of the model is better in reasoning, and that's why they continue to kind of put bigger clusters. But is there a cap in terms of how much improvement we are going to see when it comes to building these clusters? And we don't know that cap yet.
Is that lack of clarity why, some investors are punishing the stock this morning?
Yeah, I mean, look, with 25 times forward earnings, the setup was such where you had to beat and raise by a huge amount, and everyone wants to see NVIDIA type earnings. But clearly, I think with Microsoft and Meta, it was more in line and the valuation was rich. In the case of Google, the setup was it was trading at a discount relative to other hyperscalers, and that's why I think they saw
Satya Nadella had this point to make. The company's AI business is on pace to clear a $10 billion annual run rate of revenue next quarter. Is anyone even in that space with them?
Well, I mean, when you look at Google Cloud, they said it's a multi-billion cloud contribution from AI. So we are modeling it around 2 to 3 billion. Amazon, given it's the largest cloud provider at over $100 billion run rate, my guess is they're also in that $5 to $6 billion ballpark. So they're all close. But the fact that Amazon was the leader and Google Cloud was small, and now Amazon is behind Azure when it comes to AI monetization, that is what we are watching out for tonight is Amazon able to catch up when it comes to AI services revenue?
Let's finish on this. Alphabet, $2 trillion market cap, 181,000 employees. 25% of the coding now done internally by AI. What do you think that number's going to look like? Are we going to 50 overnight, 75? And do we just stay at 181,000 and maybe even decrease?
I mean, look at what they did this quarter. They grew revenue, 15% with flat headcount. And that is a setup you can expect, given how many businesses they have. They are able to maintain, that mid-teens growth at a $300 billion revenue run rate without growing headcount. That is a sign of what's to come.
These are the internal efficiencies. What does it mean for their customers going forward? Not just for the Googles of this world, for the Microsofts. I want to understand what the future looks like a few years out, because this could have massive implications for the labour market in this country and beyond.
Yeah, I mean, that's the sort of promise that Copilot has. And in some cases, the tools are further along when it comes to, how much efficiencies they can bring. In other cases, we're still in the early stages. But that's why these companies are spending $80 billion, on CapEx.
Neither of us are running companies, so we can say things that CEOs can't. Give me your unvarnished view. When you hear CEOs walk around and say things like, people will get more productive, they can have more time off if they want to, do you think they're only explaining one side of this story to us? Is there a darker side to all of this in years to come? Could there be a lot of people without a job?
I mean, everyone has to adapt. Everybody. And I think change is always hard when it comes to, technology and anything else that goes around. And I think overall, I would say there will be new types of profiles. They will make us efficient in some areas, but clearly there will be a lot more automation. That's the whole essence of an AI agent.
I know you've given thought to this. How is education going to change in years to come to address this?
I mean, kids at school are, I think, a lot smarter than when I went to school.
No doubt.
And look, everyone is, using specialized kind of tutors now. And some of this is driven by AI in terms of customized tutoring. So those are the types of personalization you didn't have before.
We've told a generation of kids to go and learn how to code. They're going to graduate and we're not going to need coders. What are they going to do? That's what I'm thinking about, and what the politicians going to do in years to come as they embrace this technology and it rolls out, and we end up with a lost generation, potentially. I raised this question in the last year, and I think it's a really, really important question. Is AI going to do to services what globalization did to manufacturing? And if you think about the political moment we're in right now in this country, which is off the back of what we've done to manufacturing over the last few decades, I want to understand what we're doing to services over the next several years, because this is arguably moving much more faster, more quickly than globalization ever did, the way that ate up manufacturing. How quickly are we going to sit here a year away, 2 years away, before we see massive cuts to back office staff at banks on Wall Street, huge cuts to compliance, big cuts at these tech firms? How close are we to that moment? A year away? 5 years away?
I mean, you have to look at the accuracy of these tools as well, right? So you're going to implement this in production use cases only when you are fully sure that it will work with 99.9% accuracy. And that's the hard part. That's what we are seeing with, autonomous driving, for example. The reason why it's taking so much longer to roll that out is the edge use cases cannot be solved for. And that's where, it's a lot more iterative. That's what companies are looking for, but these models are getting better and better with reasoning.
You can see how this would be a big discussion on a campaign trail a decade out.
Well, already you've heard Elon Musk this entire year talk about the fact that he is nervous about AI, the dark side of it, and he's even said at tech conferences, it can take all our jobs. This is someone who also obviously is going into things like autonomous driving and who has robots, even though at the moment I think they're run by humans, but that is the direction of travel, and he says it can take jobs away.
With remote controls in the back. Mandeep, it's good to see you. Appreciate it. Thoughtful stuff. Mandeep Singh there of Bloomberg Intelligence. Coming up next on this programme, breaking PCE and jobless claims data. Joining us to react, Seth Carpenter of Morgan Stanley. We'll catch up with Lindsay Rosner of Goldman Sachs Asset Management. All of that and more still to come. Mike McKee will break down those numbers for you in just a moment. The scores in financial markets about 60 minutes out from the opening bell. Equity futures here down by 5 or 0.6%. In the bond market, yields lower by a basis point or two. 428 on 10s, on 2s, 418. From New York, this is Bloomberg. Some pushback about the comments regarding the Philadelphia Eagles, for which I apologise. That was not my intention to throw shade at Philly. Please redact with that. Some economic data just seconds away. Equity futures on the S&P 500 look like this. We're down 0.5%. On the Nasdaq 100, we're down by 0.6%. The Russell, the small caps, just about unchanged. Mega cap tech in focus later when we get earnings from Apple and on Amazon. With some economic data right now, including jobless claims in America. Let's cross over to Bloomberg's Mike McKee. Morning, Mike.
Good morning, John. We have a lot of numbers to go through. Jobless claims, you mentioned 216,000, a big drop back to where we were about 3-4 weeks ago. That's down from 228,000. So no problems in the labor market. Let's see on the Fed's inflation mandate. The PCE price index comes in 0.2 higher, which is above last month, but as predicted, which leaves us at 2.1%. For the headline number on a year-over-year basis. The core up 0.3. That is what was forecast, and that leaves us at 2.7%. Same as last month. There was an expectation it would fall to 2.6. Personal spending up 0.4, stronger than anticipated for the month. That's real personal spending. Regular personal spending unadjusted up 0.5. That is also higher than anticipated and significantly up from the prior month. Personal incomes up 0.3. That is as expected. So the other number we have out, the employment cost index, up 0.8 down from a 0.9 gain. So at this point, to sum it up, before I go into all of the underlying numbers, we've got no problem in the labor market, no problem with inflation, and it looks like companies are getting either some higher productivity, but they're spending less money to get done what they need to get done.
Mike and McKee, I want to sit on one number, and we'll make it really simple. And the number's 216. The estimate was 230. 216. Now, a word that's been used a lot over the past few weeks regarding the labour market, noise. Get ready for noise. What noise really meant, though, was weakness, but weakness that you can look through. Michael McKee, we're going into payrolls with jobless claims at 216. How on earth are we at 216 when economists are running around saying, get ready to discount the jobs numbers tomorrow? You're going to see a hurricane impact. You'll see a strike impact, maybe some noise regarding the election as well. Mike, how do you frame a 216 this morning?
Well, it's hard to put it in the context of a feeling that you're going to go into recession or see a problem in the labor market. But the one thing you can look at is the fact that the jobless claims represent last week and the hurricanes were at the beginning of the month. And this represents unemployed people who were filing first-time claims versus people who are no longer on the payrolls, which we will find out about tomorrow. So two different things, but it does tell you that companies are not laying off people yet. So it doesn't look like the economy is going to be in terrible shape. Now, the thing we need to look at when we look at this is the number of continuing claims, and continuing claims do seem to rise up to 1.1862. Actually, they come down. From 1,862,000 to 1,888,000 was the previous week. So I lied. It does look like we're not even seeing hurricane kind of stuff anymore left in this.
Amazing. Michael McKee, thank you, sir. Yield to the front end still just a little bit lower. We're down 2 basis points, 416. Initially jumping, unlocking some high yields off the back of that economic data. On the 10-year, we're down 2 as well. Still in and around 430. Seth Carpenter, the chief global economist at Morgan Stanley, is with us around the table. Seth, 216. Should I ignore the random number generator tomorrow morning at 8:30 Eastern if it's weak, based on the fact that jobless claims are this low?
Absolutely. I think if it's weak, even if today hadn't been 216, you would have still ignored the random number generator. The bottom line is the labor market's actually pretty healthy. I think the 216 is consistent with that. I think the fact that you're getting a little bit of a drift up in the continuing claim says, boy, you know, maybe people aren't getting rehired as quickly, but there's not a wave of layoffs, and that for me is what's fundamental.
The hurricane impact doesn't seem to be there. Last week already predated, those numbers were actually below the hurricane impact, the pre-hurricane hit. And then you've got the strikes, so we're not seeing any real mushrooming into the economy off the back of these strikes either. How do you frame a downside surprise like this? I'm still scratching my head. What are we doing here down at 216?
I mean, this is the question we keep asking ourselves. So this whole expansion, we've been on the constructive side of things. When it was hard landing versus soft landing, we said soft landing. When it was late summer and we got a weak jobs report, we said don't worry about the economy is strong, and people threw rotten garbage at us and told us that we were ugly and stupid. If we've been wrong, it's because we've been insufficiently optimistic, and I think these numbers are really consistent with a super healthy job market.
So then why should the Fed cut rates next week?
I think the Fed's view on this is going to be inflation's coming down. It's clearly off its peaks. It's trending down. The number we got today, there's a little bit of sort of wobbling around in it, but I think the trend is still pretty clearly down. And so from their perspective, you can still lower rates from where we are, be restrictive, try to take a little bit more steam out of the economy without jeopardizing the prospect of growth. So I think they're trying to walk this very fine balance of being tight but not too tight.
I'm looking right now at the PCE data. Within all of this, you see a strong labor market, and you see PCE inflation data that came in slightly above expectations. At what point does that get people's attention? At what point do central bankers start caring about the inflation rate again?
Well, I think we saw, for example, in Q1 of this year, they really cared a lot. Everyone was gearing up for them to start cutting in the beginning of the year, and then Q1 data were strong, surprised to the upside, and they pushed off the rate cuts, obviously, until September. So I think it needs two things. One, a couple more months of upside surprises, because we really have had things come down. You'll remember Chris Waller from the Fed said the reason he went for 50 basis points instead of 25 was because inflation data had surprised him to the upside. So a month or two to the upside isn't going to change the fundamentals. And then you need it to be compositionally the stuff that we know has a lot of inertia, like housing inflation, that sort of wobbled for a little while. It wasn't clear, and then it came down again. And I think as long as those really core pieces, no pun intended on inflation, as long as those really central parts of inflation keep trending down, then I think they're going to feel comfortable.
Most voices on the FOMC said they didn't want to see deterioration in the labor market. That was part of their reasoning.
Mission accomplished.
Right. Well, seriously, what do they come out and say in terms of the assessment of the labor market on Thursday?
I think you're going to see words along the lines of solid, robust, healthy. The unemployment rate is 4.2%, so it's up off of the lows. We had an unemployment rate that was around 3.5%. So I think you have to be able to say that there's been some cooling. If you look at the job openings data from where it was when the labor market was tightest, you have to say there's been some cooling. So I think in that regard, they're fine. The pendulum had swung a bit too far. People got a little bit too breathless over a couple of months of jobs data. We're not deteriorating.
Let's talk about the other big event next week, and that's the election. You're spending a lot of time talking to clients, and something that was interesting in your notes is there seems to be a differential for clients that are in the United States and those abroad. And what is that centering around?
So I think one of the key parts is tariffs, right? So the election is going to have, from a top-down macro perspective, 3 key policy implications: tariffs, immigration, and fiscal policy. And to a person, when I'm overseas, all investors are convinced former President Trump, if reelected, will go back to putting in tariffs, and there's just no doubt in their mind. I think there's a bit more debate and difference of opinion on this side of the Atlantic. People who think either, it's going to be a negotiating tactic, or if in fact he announces it and it ends up being bad for the market, for the economy, then it won't come through. So I think that's an interesting dichotomy of views.
You've got to work out who wins. You've got to work out the makeup, the division of government, if there is one, if there's a sweep, if there's not a sweep. Then you've got to work out whether the promise becomes reality. Once you've got there, okay, let's just deal with this. If you take everything that's been said on the campaign trail, is it a stagflationary proposal from the Trump side? Is that how you see things at Morgan Stanley?
Absolutely. If you were to literally take everything that's been said, let's just deal with tariffs that we were talking about before. If you had, in January, 60% tariffs on everything imported from China, 10% tariffs imported from everything around the world, I think that pushes up inflation, and that probably happens first. The numbers we've calculated are in the 0.9 of a percentage point kind of boost. But the drag to growth could be as much as 1.5%. I mean, I think it really is important. And that ignores the immigration side of things. The reason we had 3+% growth for a year and a half, and inflation continuing to fall is because we've had this big add to the labor force.
How different is the Harris proposal as things stand when you go through that big 82-page document on a website, 82 pages long? Yep. When you go through that, how different is the proposal?
Well, I mean, I think, again, going back to tariffs as an example, I look at what the Biden administration has done. They put tariffs on electric vehicles coming in from China. Boy, that's almost entirely rhetorical, right? There aren't that many electric vehicles that have been imported in the United States from China, and so it's not going to have anywhere near the same effect. We can look back to 2018, 2019, and see the hit to industrial production, industrial output from that wave of tariffs. I think there's a pretty meaningful difference.
Market participants are running around saying, not a big deal, we'll work through this, stocks go up and to the right. That's what the chart always looks like over a long time. Do you think this does have the potential to really redefine things years out, this election? Do you think it's that important?
I do think so. The rejiggering of the global supply chain, the rejiggering of global economic interactions, that's real. That's been going on for some time. It got accelerated with tariffs. I think another round of tariffs, another trade war could, in fact, accelerate that rejiggering in ways that maybe we can't fully anticipate.
Seth, it's good to see you, as always. Thank you, sir. Good luck over the next week. Seth Carpenter there of Morgan Stanley, going into payrolls tomorrow. Then, of course, you know the dates by now. Tuesday, the election. 2 days later, the Federal Reserve decision. We just got some data here in America, and this is what it looks like. Jobless claims coming in at 216,000, the right kind of downside surprise. We were looking for 230. 230 was the estimate, 216 was the number. Tomorrow, this is the estimate we're looking for tomorrow, 101K in our survey, 254, the last number. Equities right now down 0.6% on the S&P 500. On the Nasdaq 100, we're down about 0.75%. In the bond market, yields look like they're still lower on the session, down about a basis point on a 2-year to 416.61. On 10s, we're down 2 basis points to 428.24. Jumping in the seat, Lindsay Rosner of Goldman Sachs Asset Management. Lindsay, good to see you.
Good to see you.
Got to start with this economic data. Is there anything not to like? Jobless claims, GDP, looks pretty good.
Looks good, looks fine, looks quiet. I think that's something that's a big relief right now. There is a lot of volatility priced into the market. If you look at the MOVE index, which is looking at rate vol over October, it's gone, like you were saying, top to the right for equities. It has made a move for sure in October. This is a good day of quiet. I think the event will actually be month end at the end of the day, not the data this morning.
Walk me through why.
So there's actually going to be a pretty decent rebalancing. So if you think about how bonds have performed in October versus what's gone on with equities, you want to shift your portfolio given the outperformance in equities. You have the normal month-end extension, which happens always with indices in the bond market. So there has to be kind of this natural buying of duration. But there's going to be this additional, much bigger thing of asset allocation out of equities into bonds.
So are you saying that essentially this is noise and it's the technical underpinnings that really will drive yields lower regardless of what happens with all of these different events next week?
Well, today's story is going to be the month-end story. The things that happen over the next week are actually big. Besides from the data prints, we've got auctions, we've got threes, we've got the bond. We have obviously the election, and then we lead up to FOMC. So not necessarily that yields are going to go lower for the rest of the week. I think we're in a moment of a lot of volatility between now and then, but today's movement, I think, is really month end.
Do you see a shift in the narrative, though, right now, where people have just been underestimating how strong this economy is? And that has been the theme again and again and yet again here as we wait for potentially weakness that may not show up tomorrow in the jobs report. Is there a sense that there could be a reacceleration in inflation in a more meaningful way? Is that starting to come back to the table in the discussions that you're having?
Yeah, and that's been a big explanation for what's happened with yields. I mean, the amazing thing is the Fed cut 50 basis points, and we're now 60-odd basis points higher across the curve. That is pretty tremendous, and a big part of that is a concern about inflation because growth just is that good. But I think on going forward, we've got a lot of noise that's going to happen in the next week, but things are going to calm down. And I think we'll have a lot more certainty. And the way we actually are talking with clients right now is that you've got a huge opportunity with this move up in yields. The economy is good. The Fed has the power to do what it needs to do. And where we were a month ago was much lower yields, or a little bit past that, earlier than September 18th, earlier than the cut was, you know, you're waiting on the Fed to see if they are going to go and how much they're going to go. Well, now you actually have an entry point of higher yields, and you know that the Fed's going. That's a home run, and this is a great opportunity to be in fixed income.
Is there a chance they skip, though, and push this decision to December?
There's always some probability around skip, but we think the conversation around skip is really something of 2025. We feel pretty good that the Fed's going to go 25 next week. They're going to go 25 again in December. That puts them in a really good spot. They've done some hard work at, chopping some wood there of 100 basis points. Then they can pause and survey what's going on.
They have to pause, right? Because policy in 2025, does anyone have any idea what that's going to look like?
We do not know right now. I think you're absolutely right. But they will start to have an inclination. We'll obviously know a lot more. We may not know on election day who's actually won and how everything else shakes out, but we'll know pretty soon and what those policies do look like. It's going to take time, though, to your point, to implement them. And so for us right now, I think a lot of people want to talk about how do you trade the election. It's not about trading the election, right? It's about where do you want to be from a long-term portfolio allocation. For us, we think it's really important from a strategic value perspective to get bonds into your portfolio. And we think there's no time like the present.
So Treasury is a big piece of that, given the rise we've seen in yields across the curve by about 50 basis points. High yield spreads are super tight. On a historical basis, 276 right now. How do you frame that for clients at the moment? What's the opportunity look like in corporate credit in America?
Corporate credit is tight, but I think what's so amazing right now is that you've got a ton of volatility in the rates market. We've had no volatility in the credit market. So what's behind that? So we start to unpack it. What's behind that is there's not a recession. Balance sheets are strong. Management companies are doing the right thing. But when you go underneath the hood of the car and look at what's happening in high yield, something that's flagging for us is just how well triple Cs, so the lowest of low in high yield, have performed on the past month. That to us is a little bit of a complacency indicator. So not all those companies make sense, not all those balance sheets make sense, and it has been off to the races for triple Cs. That for us says this is really important to have an active manager in this environment because, yes, maybe triple Cs did well this month. Long term, there are a lot of companies there that aren't going to do well, and you want to make sure you're in the right spots.
How are you navigating? What are the right spots? I imagine there's an up in quality bias. What are the right spots right now in corporate America?
Right. For us, it's really kind of a curve thing and a quality thing. We've spoken before about we like the front end of the corporate curve. We think that that's going to do a lot better than the back end. So that's how we're positioned in terms of maturities. And then we are down in quality and investment grade. BBB companies are doing all the right things to stay investment grade. They don't want to be in high yield. And then in high yield, we're up in quality in those double Bs and single Bs and specific names that we like.
Do you expect more tech-related issuance coming into the fore, not necessarily tied to tech, but tied to some of the investments and the infrastructure around them that you expect them, and they're talking about having to make?
Yeah, there's definitely going to be CapEx. And it's interesting you bring up the CapEx expenditures on tech. That is actually back to areas of corporate credit we have to think about and be more cautious on, one of which is utilities when it comes to spending. That's a spend we're actually really concerned about in terms of the CapEx that's needed for going green. So that kind of the drivers of who needs to spend and for what, and are they going to be worthwhile projects, or are they really just going to be on a drain and regulatory? That really guides the sectors that we like and those that we stay away from.
It's a fascinating sector right now, that's for sure. Lindsay, it's wonderful to catch up with you, as always. Appreciate your time.
Thank you.
Lindsay Rosner there of Goldman Sachs Asset Management. Equities at the moment on the S&P 500 recovered just a touch. We're down 0.6%. With an update on stories elsewhere this morning with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John, just a recap of some of that data we got out moments ago. Jobless claims fell to 216,000. That is a figure that is below every single estimate from economists and the lowest since May. Elsewhere, in inflation data, core PCE rose 2.7% year over year, slightly hotter than expected and the biggest gain since April. Inflation-adjusted consumer spending, that also advanced to 0.4%. Tech earnings are weighing on the NASDAQ this morning. Meta and Microsoft both delivering disappointing results. Meta warning of more losses as it continues to ramp up spending on AI. Those shares down more than 1%. Microsoft forecasting slower cloud revenue growth. Those shares down 3.5% pre-market. Investors now looking ahead to earnings from Apple, Amazon, Intel, all after the closing bell. Starbucks' new CEO, Brian Niccol, is working on plans to turn around the company. He wants to reduce drink customization, trim the food and beverage menu, and bring back ceramic mugs and a condiment bar. Niccol also set the goal of getting drinks to in-store customers in 4 minutes or less. And that's your brief, John.
Big changes. Danny, thank you. You happy with those changes?
Well, they're bringing back the fact that the barista will now write your name, and sometimes the barista's a little bit more creative when they write your name, or they add like little characters or hearts instead of just, this very corporate, sterile printing of the name on a machine.
Very defensive about all this over at Starbucks, aren't you? Very surprised by all of that. Up next on the programme, we set you up for the day ahead. Payroll's just around the corner with some big earnings after the close. We will hear from Apple. We'll hear from Amazon. Ed Ludlow, just around the corner. The opening bell 38 minutes away. Equity futures down 0.6% as we count you down to the opening bell. Here's the trading diary, the calendar, the week ahead. Today we'll get results from Apple, Amazon and Intel after the close Friday. Payrolls data Tuesday. The US presidential election Thursday. A rate decision from the Federal Reserve. And on Friday, UMich consumer sentiment. Investors in the meantime awaiting another round of big tech earnings after the bell. Bloomberg's Ed Ludlow joins us now for more. Ed, welcome to the show, sir. Based on what you've seen and heard over the past few days, what are you looking for later this afternoon?
It would have been excellent to kind of have consistent reaction in the markets to Meta and Microsoft as we saw with Google, but there is a consistent storyline, which we've talked about. You take the commentary or forecasting for CapEx and then the commentary and forecasting for growth. And in Alphabet's case, they demonstrated that they could sustain growth while spending. Microsoft told us that the top line for Azure, its cloud unit, would decelerate sequentially into the current quarter, but still have beyond 30% growth, which is enviable. They're also supply constrained. And in Meta's case, the same thing. They will continue to spend. They lowered the range for this year by $1 billion, but it's all still almost $100 billion spending on AI. And warned that next year capital expenditures would increase. However, their losses will also increase. So the market's trying to take all of this and say net, is AI really still a thing? And it seems like it is. It's just more expensive than anticipated.
Ed, it's really interesting that we got basically the AI behemoths, the cloud providers, and then we're going to hear from Amazon, who also is a cloud provider, as well as Apple. And these two companies are much more leveraged to the consumer. How different will the nature of these earnings be to the ones we've already gotten?
Yes, although Amazon likely to be held to a similar standard, right? Because AWS is the market leader in cloud, and it is the cash cow for that business in the operating income context. And what's so interesting about Google Cloud, which is the number 3 player, and then Microsoft number 2, both of them seem to demonstrate, even say they've taken market share in the quarter, which would logically follow that Amazon ceded market share to them. And it would be interesting to see if that's the case based on their numbers. Apple is a fun story. It's why I love coming on Surveillance. It's just about iPhone and the latest generation iPhone. And if we'd like, we could talk about China, but that's all it comes down to.
When it comes down to China, it's about the timeline for getting an AI partner for AI intelligence. Ed, what is that timeline?
Yeah, it's so interesting. So I just upgraded my iOS to 18.1, and I'm on the wait list for Apple Intelligence. And it's frustrating. Apple hasn't yet told us how they make money from this, because they're all sort of proprietary technologies that come with your phone if you have an iPhone. I think we talked about this before, but the reason China's so interesting is that there's evidence the iPhone 16 has sold well there, a critical market, even though the AI tools won't be available because the regulator doesn't permit them. So the question is the Chinese consumer buying that handset in anticipation that at some unknown date in the future, they will be able to use Apple's AI offering? That's a really fun one for executives to try and explain away on an earnings call.
Stop having so much fun. Ed, looking forward to the programme later. Ed Ludlow, thank you, sir. 11 a.m. Eastern Time. Ed Ludlow alongside Caroline Hyde on Bloomberg Technology, anticipating some big earnings releases a little bit later after the closing bell when we hear from Amazon and Apple. We'll also hear tomorrow morning from Sarah House of Wells Fargo, Priya Misra of JP Morgan, Nadia Lovell of UBS, Mohammed Al-Erin of Queen's College, Cambridge, because tomorrow morning is the big one, 8:30 Eastern Time. Payrolls Friday. The estimate in our survey, 101,000. The previous month, a blowout. Upside surprise on the jobs report, 254. A little bit early this morning, jobless claims much better than anticipated. 216. Is the risk tomorrow a big upside surprise or a downside surprise? That debate tomorrow morning from New York. Good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.